NFTs? Like what sort of use case do they even have? Because on different other platforms, there's some gamified element to it. Is this basically just like a novelty, like kind of like the ICOs, right? Where they were just an ERC20 token with a wallet. Are these sort of like the same thing where they're just an NFT that's like, oh, thank you for giving us money or what have you?
Yeah, there's lots of distinctions to be made in with like inscriptions and like ordinals, right? Because like there's the aspect of sure it can be an image of whatever, right? And people try to say and call it digital art, right? But then there's also the use case of just inscribing information to the blockchain and then not actually selling um, that as digital art, right? Like those are two completely different things, but they use it's the same technology. But what people were mad specifically about Bitcoin Magazine is that they put on what they call digital collectibles or digital art, and then just selling it outright in an auction style fashion, kind of like an ICO, essentially. A little bit of different dynamics with how the auction was actually operated in like a Dutch format, but nonetheless auctioning off digital collectibles. And I guess some people are not super enthusiastic about that.
Huh. Well, I mean, outside of that, man, I believe the last time that we had spoke, you were right on all your forecasts, dude. You're like, the next one is Silvergate and all that stuff, and Genesis. I believe we spoke like mid-December along that time frame, and that was some pretty wild stuff back in March. And as far as like price action goes, I believe you and I had agreed that like end of year we'd be around these levels, like the 28K, 32K level, man. So I found that to be pretty interesting. Is there any like recent data to suggest that we could be seeing extended periods of volatility to the downside or the upside? I haven't been keeping up with Magoo as much as I should have on your adventure across some of these Twitter spaces.
Yeah, I haven't. I guess I haven't really been on too many Twitter Spaces. Not much has really been happening since the March. I think I had a space talking about kind of like the banking crisis. Ever since then, things have really been quiet for the most part. At least in like if you just want to look at equities. Um, but there's some pretty big signs of distress in the market, right? Like the banking crisis happened, um, but the Fed is still raising, and I think they actually might raise again, um, because well they can. But in the Treasury market, we're seeing quite a big rush for collateral, like especially on the short end of the curve. Like how fast um the yield is dropping on like just say like the 1 month, like the T-bills or the 1 months. They haven't moved like that since 2008. Like the other day, like yesterday, I'm pretty sure uh the 1 month dropped like 25 basis points, which is like that's insane in one day, right? Like these are acting like shit coins, to be honest with you, how big of these moves are. And at one point in the day it was down I think over 50 basis points, and recovered a little bit, and even now today, um, it made back some of that ground, and then it literally gave it all back during the day. Like if you look at the 1 hour, basically, around like 2 p.m. Eastern time, it actually started to try to rally a bit, but then into the close, and now it's even lower than where it closed yesterday. So there's a huge rush for collateral because there's a huge dispersion, um, between the Fed funds rate and the 1 month Treasury yield, which shouldn't happen, right? It means that people are putting a massive premium on collateral because it's not just the yield that people get from these T-bills and these treasuries and these bonds. It's the functionality that allows them to actually operate as either banks or shadow banks or just regular financial institutions where they need this collateral to actually operate, whether it means needing that collateral for collateral levels to basically issue more loans. There's a lot of different things why people would need this, and there's just been this huge dash for treasuries on the short end of the curve, causing this huge disparity um, in the yield curve, right? Where you have now the yield curve, like the 1 month is at like 335 basis points, and then you have the 2 months at almost 500 basis points. Then you have the 3 months at basically 510, the 6 months around 505, and then the 1 year at 47, and then basically then it goes down again, right? So it's like a weird the weirdest curve in the yield curve that I've ever seen, really, where it's inverted, but only only at like the 2 months and the 3 and the 6 and the 1 year, like everything's inverted except the very short end of the curve. Um, and why that is well, people need collateral, but like the real question is that we don't know. We can guess, but who is it that are bidding on these on the short end that are basically not even caring about the yield and just getting their hands on that collateral? I don't know. Is it banks trying to change the ratio of their loan book, like not their loan book, but what their collateral is, so they actually have more treasuries on the short end of the curve instead of on the long end? Which is probably true because the Fed has what they've done is they've created that program in March where uh, quote unquote people who have access to the Fed window or the discount window, they'll have the ability to basically give the Fed lend basically long dated treasuries, and the Fed will give them money directly up front at 1-to-1 value, like literally 1-to-1 value of what those bonds were originally, right? Even though they're underwater right now, right? This is what caused Silicon Valley Bank to blow up, right? They had a mismatch in liquidity where they had all these people wanting their deposits back, but they had all their money allocated to long-term treasuries, which were down 20-30%, and they were having to sell them to kind of to get liquidity, but they were underwater, so they were having to realize that loss, and that's a huge loss. And all of these banks have that huge loss. It's just not marked to market because of the way that accounting works. And so now the Fed has given them a tool to basically get instant liquidity without taking a loss. They're doing that, and it appears to be that they're taking all of their treasuries on the long end of the curve, and they're taking them to the Fed. They're getting dollars for them, one for like basically at par of what their value were when they bought them, and then just bidding the fuck out of the short end because they still need that collateral, but they need to change the kind of the duration mismatch of their bond portfolio. But why they're bidding the fuck out of it? It means that they are just moving from the long end to the short end, and they're not actually like using the tool that the Fed gave them to basically allow customer deposits to come out. They are essentially just using it for themselves and just putting all the liquidity on the short end. It seems like that's the only way, or the only institutions that I think would have enough money to be moving the short end this much. And so they're just kind of I'll call it reformatting where the duration is across their bond portfolio. So it's super super interesting. But there's been a huge race for collateral on the short end, which we've seen.
Magoo, so are these entities betting for another liquidation event, as we saw basically in March.
A liquidation in terms of what? Like in terms of banks or in terms of like consumers
Banks,
trying to make
bank,
runs
bank
on banks?
yeah, banks in specific. And I've been speaking with individuals a bit older than myself. I'm about to turn 26 in a couple of months, and with individuals that lived through '08, they kind of said, like, the current rumblings going on right now in some financial sectors is very reminiscent of the 2008. I believe I believe it was like Lehman who collapsed before uh, Bear Stearns. Like it was like six months before, and then after that, a couple months later, going into early stages of 2009, we had that massive, pretty much down only environment, like the first quarter.
Yeah, it is. It is GFC esque because the only time that we've seen this big of a move in the short end of the curve, at least the last time, was the GFC, where you've seen rates, their yields precipitously drop on the front end of the curve at this fashion. Like you literally just, if you pull up your trading view and you go look at just like the 1 month, you're gonna have to go to look basically at 2020 to see basically that the drop that has happened, and then before that you see 2008, where there was that much basic drop in some of these yields. But that's what they're doing. Like if that is what's happening, and the banks are reshuffling their liquidity profile to have their portfolios on the front end of the curve, it means that they expect that they're going to need that liquidity sooner than later. And what that means is essentially is that they think people are going to be needing to have access to those customer deposits, um, more so than keep them in the bank. So they're setting themselves up for to be able to withstand massive amounts of withdrawals from customer deposits. And what that is, in other layman's terms, it's like that's a recession, right? Because that's when people basically they stop spending, and they have to basically dip into their savings, and they dip into their deposits, and everyone does, and to basically get the money. And that's what these people are probably doing. It's like they're making it, if people need to get access to this capital, then they can get access to it and not affect the bank. Because before, without this tool that the Fed has introduced, apparently these banks didn't actually believe the Fed, and they just kept on buying long dated Treasury bills or bonds, and the rates kept going up, and they kept going more underwater and more underwater. Um, and then it one little liquidity spike or drain where people actually need to take their money out, and they had to go and sell these long dated bonds that are underwater. And so now they're just basically creating that, they're changing the dynamic so that if that does happen, they can actually facilitate that without like bringing down the entire banking system.
It on over to Forest Green. I know I want to speak with you for a while, so I don't want to hog up the mic too much. So I want this space to be more interactive for the BB community. So Forest Green, I saw you post something up on the nest, so feel free to share that with Magoo.
Hey Magoo, hey Wally. So I was trying to find the chart, but I think it's more expensive now to borrow money than it even was in 2008. I can't seem to find the chart, but it was in my feed earlier.
Oh, it definitely
Um,
is. It's definitely more expensive, whether you want to look at mortgages or if you want to look at car loans. it's more expensive now to borrow money than it has been in like 30 years. Like just you just got to go look at rates, right? Like if you just like the simplest, just like pull up the 10 year. Like you just pull up the 10 year and just compare that throughout history, and that will give you a pretty good indication of how expensive it is to basically get access to capital. Um,
Guys, so I want to follow you up there, Magoo. Is the reason for capital being more expensive than it has in 30 years, is that due to, rates being hiked in the most aggressive, 12-month time period since Paul Volcker, right? So we went from 0 to a little over 5% in 12 months, right? So that's like a what? A 500 plus percent increase. My bad, 400% plus increase. Is it due to that or another underlying factor that I'm currently not aware of?
well, we had like in terms of like percentages, like this is a faster rate hike than even Volcker. In terms of real numbers, it's not right because he went from like I think it was like 7 to like almost 20. But in terms of percentages, we went from literally like 50 basis points on like the like if you want to look at Fed funds was like whatever it was 25, 50 basis points. Now it's over five in the span of like essentially a year. So in terms of percentages, that's like five, six, 500% increase. Like so, like there is no wonder there's been massive volatility in a bunch of different things because like the cost of capital has changed drastically, like insane amounts. Like if you just want to look at like like the 10 year peaked around um 4.5%, right? And the last time that it was that high was basically leading into the great financial crisis, right? Like I think in 2007, like it was around roughly the same. And the last time it was higher than that, it got a little bit higher than that from like 2000 and I think let's see here. So there's a couple peaks from 2004 to 2007 where the 10 year was higher than that. But other than that, the 10 year hasn't been that high. And then the Fed funds rate, but like it basically it peaked in like if you want to talk about it, like peaked in like the late 70s, right, with Volcker, where it's at like 15, 16% or whatever it was, and it's been on a downwards decline ever since then. And if you're like a TA person, like this is the first time it's kind of broken out of that channel, just like down, down only from like the late 70s. But capital hasn't cost this much in a very long time. Basically, you'd have to look at pre GFC to find capital costing this high, essentially. Um, and that changes everything. That changes the dynamic with car loans. That changes the dynamics with mortgages. That changes the dynamic in venture capital. Changes the dynamic in private equity. It changes the dynamic almost everywhere because the cost of capital is like 500% higher than where it was in COVID, and so that changes everything from PEs on stocks to basically how much your car payment is every month, and it's changed in a bad way. If you want number to go up with any asset, almost every asset, like with cost of capital being as high, more people are likely to park their money in treasuries than they are to YOLO them in fucking shit coins or meme stocks, right? And it basically takes the wind out of the sail of a lot of the risk assets because of the rates being so high.
I'll pass it over now. Oh, go ahead, Forest Green. Go ahead. Then we'll pass it over to Snorlax and Premise.
I mean, this is kind of a broad question. I've been listening to you for a while, Magoo, and I know you are kind of well connected in the financial space. So I was just curious, is there anything you're particularly eyeing for kind of the next credit event or like something you're really just kind of keying in on going, hey, that might be what breaks? Or
Um,
you just
so this isn't any secret, but commercial real estate's in a really bad state. Like a lot of people have been talking about this over the last, I don't know, month. And I'm not like a real estate expert by any stretch of the imagination, especially even commercial real estate, which is a completely different beast. But a lot of commercial real estate is structured a lot differently in terms of the financing when it comes to like, as you would call it, like a mortgage, basically for you to buy your house, and you have like your monthly mortgage bill. Corporate real estate is a little bit different where the underlying owner cares more about free cash flow and how much equity they have in certain deals, and how much the vacancy and the basically the occupancy rate is of a building, and how much free cash flow is coming in, and if it's actually um, enough to actually pay their mortgage, because they don't operate in a state where it's like we're underwater and we're going to continue to be underwater. They'll just hand the keys back unlike normal real estate where people need somewhere to live. um, and so with the occupancy rates of where they are now, and they're only going to go lower just because like corp corporate real estate or commercial real estate is, there's a lot of different subsectors in it. Some of them are going to be stronger than others. Like the weakest one's going to be office space, and specifically like class B office space, like not like the bee's knees of office spaces where it's like the building is amazing and it doesn't matter what really happens. There's always going to be a tenant because it's just like some of the best buildings in like downtown Manhattan, or let's say in San Fran, and it's the newest building. But then there's like Class B, where it's like not the nicest buildings. People are less likely to go to the office because it's not amazing, and those deals have a very high risk right now of the owners just walking away and handing in the keys, because the work from home like is never going away at this point. The way that I see it is there was this idea coming out of COVID that we're going to go back to normal in terms of like how people actually operate in white collar jobs, and basically everyone going back to work. But that's not happening ever. Like that has been is becoming more and more and more apparent, and I'm even seeing this like anecdotally with hiring people and looking at the market that I'm specifically focused in. If you are at like on-prem job, you probably have to offer like a 20-25% premium on your offer to candidates for them to even consider it, um, because of how much of a disadvantage it is for them to have to go into work, whether it's the cost of them having to drive there, or the cost of them in the time manner of like, well, I'm going to be wasting 2 hours of my day commuting, whether it's driving or sitting on a train or whatever it is. And also, there has been this huge mass migration of white collar workers all over the United States because they said, well, I'm getting paid $180,000 to do my office job that's supposed to be in Manhattan or supposed to be in San Fran or Houston or Miami. I can keep that and go move to fucking Cincinnati or fucking Toledo or anywhere, name like bumfuck anywhere, and basically your cost of living is more than cut in half, and you're keeping your salary. And so that's not changing, right? And where we're at with the job market is job like employers have to suck it, because if they don't do that and they don't allow them to work from home, they're just cut out of like the top tier candidates in the marketplace, because the people that actually know what they're doing, that are worth anything, they can demand anything right now, because the job market is at a generational historical low in terms of like or not low, but like how tight it is, and how much of a demand there is for actual talent, and how little talent there actually is. And so the people that have talent, and these are the people that are getting paid these huge salaries, that they can dictate what they want and move anywhere on the planet. And some of them are even leaving the United States altogether. Um, and they have to do it. So work from home is not going anywhere. And that's putting a huge, it's literally putting, it's like a generational like trend that is changing. And that the first sector that's going to get hurt bad by this is office spaces. And that's just one part of commercial real estate, and there has to be a massive revaluing. Like when I mean massive, I mean like 30, 40% valuation change to the downside for some of these office spaces, right? It's not going to be as precipitous as some, depending on your location, but across the board, there's going to be a huge repricing of office spaces because no one fucking needs office spaces anymore. Everyone's working from home. And so without that demand, there's a fucking huge shock, right? And so there's going to have to be a huge repricing of that. And one of the problems that that brings is most of these deals, like most of these commercial real estate deals, are done with regional banks. They're not done with your JP Morgans. They're not done with your Bank of America. They're done in localized parts of the country, and those deals are done with local banks, right? Call them community banks or call them regional banks, whatever you want to call them. But most of the commercial real estate deals are done with those banks because it's higher risk, and they're gonna suffer because at the end of the day, the landlords have the ability to just walk away from the deal, and the people that are going to be holding the bag are going to be basically either the bondholders, like whoever owns the actual credit, like the debt, like so whoever if they've repackaged that debt and sold it somewhere, those people are going to be sitting on it, or if the banks haven't done that, the banks are going to suffer, right? It's not going to be the people that actually own the, right now that own the buildings. That's why it's ironic how commercial real estate works. Like they can walk away from a deal. They can be like, well, I had 10% equity in this deal, um, and the rest with credit, basically, right? That's essentially what I'm saying. And let's say the real estate gets repriced 20%, they're now negative 10% into this equity, to this building. Well, they're like, okay, I'm gonna walk away, right? Like, it's done, right? And they just hand the keys back. Bada bing, bada boom, it's done. And then then it's left on the bank and whoever owns that actual debt, if they sold it and repackaged it in some form of MBS, that gets burnt on it. So I think that is a huge sector that will that there is going to be another huge credit crunch coming from. And then normal real estate is whatever you want to call it, residential real estate. That's not going to come down nearly as much. It's not like a 2007 and 8 type scenario where everyone's leveraged to the fucking teats. It is going to come down more than what it already has, but is it going to come down another 30%? No. Is it going to come down 20? Nah. Is it going to come down another 10 to 15%? Probably. But that is going to be less of a cascading failure because now we don't have, at least in the United States, there's not as much variable rate mortgages where people are all of a sudden realizing that their payments have went from 1,500 to 3,000. Now that's different in the UK. That's different in Australia and New Zealand and also Canada. Those countries, which are all Commonwealth countries, they still operate on variable rates. They have fixed. They call them fixed rates, but they're variable. And I think 10-year, 5-year, and 10-year terms. So they have a 10-year fixed or 10-year or 5-year fixed. But after that, they have to refinance, and then the rate goes from where, let's say, it was at prime plus 3%, but now it goes from prime plus 3% to prime plus 6%. And someone on $1 million house in some of these markets, let's say in Canada and Vancouver, Toronto, or if you go to Australia on the Gold Coast, or if you go to like Manchester, and they're sitting on $1 million property, and they're basically only 10% into the deal, and they're basically paying, let's say, $3,000 a month or $2,700 a month on mortgages, and they have to refinance now because their time is up. They just go from paying that to more than doubling their real estate payments, like their mortgage payments, which is insane, right? So if you're an individual and you're paying 3,000, and then all of a sudden it gets refinanced and now you're paying 6,000, like that's a big problem. It's so much of a problem that the regulators are going to have to change how mortgage rules actually work in those countries. And what I mean by that is, the banks cannot withstand a wave of retail, whatever, not retail, but residential mortgages to default and just hand in the keys. They just can't do it. They can't allow that to happen. So what they're going to have to do is reamortize those mortgages, right? So if you have a 30-year mortgage for whatever, a 25-year mortgage, they're going to be like, well, instead of now going from 3,000 a month to 6,000 a month, we'll just reamortize this, and now instead of a 30-year mortgage, it's a 60-year mortgage, or whatever the number is. That's the only way that they can stop the cascading of like defaults from happening, where they're just like, well, now you have to pay this mortgage over 60 years, and most people are going to take that is because they have realistically no choice, right? Because you can default on it or claim bankruptcy, but that's a whole other shit show for those people. But now you're going to have people stuck with like maybe not 60-year mortgages, but probably 40 and 50-year mortgages at this point, just to save those real estate markets. Because if they don't reamortize those markets that are super heated in like Canada, Vancouver, Toronto, England, Manchester, or the Gold Coast in Australia, those real estate markets would collapse like 50, 60%, right? And a lot of those economies actually rely on the wealth effect of those real estate valuations. And if you had a 30 or even a 30 or 40% decline in those countries would see massive recessions, right? It would be insane. And so they have to do their best to stem that from happening. And the way that I think they're going to do that is by reamortizing those mortgages. That's not going to save them completely. There's still going to be a revaluation in some of these regions, some of these super hot regions. Like if you want to look at like Vancouver or Toronto, you're still going to see like probably another 15% decline in real estate valuations from here. I think they're already down 10, 12%, maybe even 15, depending on the region. So you're probably going to see at least another 10% down from here as well. The United States, like I said, is a little bit shielded from this because of the way that after the GFC that there's no real variables, but you're still going to see overall a little bit of decline in valuations just because of the new, I forget what they call it in the real estate industry, but like the new issuance of new mortgages, um, in the lending standards are a lot tighter, and a lot more people can't afford these massive mortgages at these new rates. And so there's not as much, I think, loan origination, that's the fucking word I'm looking for. There's not as much new loan origination. Like you see this with like the the mortgage divisions or the lending divisions of a lot of these banks. They're firing their entire department, because no one is actually borrowing money, and so they don't need a whole fucking loan origination department at these banks because no one actually is borrowing. So you're going to see some of those valuations continue to come down in the states, but nothing like it's going to be in some of those markets, like in those regions I told you about.
Snorlax, go out on right ahead, brother. I want to give you some time to speak in this roundtable space. So, thanks, Snorlax, for coming on up, man. Good to see you in here, brother.
For sure, guys. Thanks for having me on. Yeah, I wanted to ask you a question, Magoo. I really appreciate the chance to speak with you. The question's pretty much on a similar topic of discussion. Since I feel like the issue of liquidity is so obvious and apparent when because I trade a lot of lower time frames. So when I look at SPOOs, when I look at the Nasdaq, I mean, like you said, it's trading like an altcoin, and it's not necessarily indicative of a healthy market. So, but when we talk about potential areas of distress, I wanted to know your thoughts on, whether or not potentially the larger tail risk now of a credit event, or, just an event period, could potentially be caused more by the private equity sector, rather than maybe the banking sector, given, the increasing exposure to a market as the levels of liquidity are actively decreasing because, personally, I feel like there are probably numerous areas where, we can talk about systemic risk and probably have it hold water.
Yeah, so that's another area that's going to see a credit crunch. Private equity, and then there's different aspects of private equity. If you want to consider VC, venture capital as part of private equity, but the best part about private equity, and it has been at least for the last since basically the peak in the markets, call it like end of 2021, or Bitcoin started tanking in November or October. Private equity has this amazing tool where they don't have to mark to market their shit, right? So the whole markets are down 30%, and private equity is sitting pretty on the private equity because it's not liquid and it doesn't trade. So they don't need to market the value of that private equity, and so they're just sitting pretty. But we're getting to the point now that they're going to have to be forced to mark some of this private equity mark to market, and that's going to appear like just like money instantaneously being vaporized, right? Like if you have a company that all of a sudden had $1 billion valuation, you can look at some of these charts too. Like if you want to look at unicorns, I like looking at this chart, like especially for Silicon Valley. You look at all the unicorns that have existed and basically the new valuations, the new unicorns that have existed. And like soon as 2020 hit, like the unicorns went through the roof. Like there's never been more unicorns that have ever existed. And it's like literally like against like you call it a unicorn because it's supposed to be rare. And then 2020 rolls around and the amount of unicorns just goes through the roof. Like it's insane with how many companies that are valued over $1 billion actually happen. And a lot of those haven't marked to market, to be honest with you. And whether the private equity firms, they have not done it yet. They will for the long as if the Fed continues to hold rates and not even raise rates more, they're going to be forced to mark to market basically some of their holdings, and that's just going to appear to be a quote unquote like an evaporation of money. But one thing to be said about VCs and private equity, they have so much cash on the sidelines. Like they've been raising so much money they've raised so much money in 2022 that they're just holding on the sidelines. Like this isn't exactly private equity, but like, take a look at BlackRock. Like BlackRock literally just raised, I think it was like $30 billion for single family houses to basically scoop up because they know they're about to take a shit on the market. And this is in the face of them closing redemptions on the biggest like real estate REIT in existence and only letting so many people get out at a time. And they're raising money on the back end of that to basically buy in on the cheap when it goes down. So there's been a lot of money raising in VC world and in private equity, right? And it's really weird because in private equity, how that works with like your LPs, and you give people money, like you're paying people to hold money essentially, right? Like you're paying people to hold your money even though they're not investing it. So it's a weird dynamic that forces them to invest it. But nonetheless, they too are not there's gonna be an event there. I don't know what that's gonna look like. It's just a revaluation of private equity, right? And basically on people's books as soon as you mark to market something, you think this person or this company has a balance sheet of 5 billion of investments, and now it's 3 billion overnight because they mark to market, right? And that's gonna cause some shock, right? Just in that of itself.
Premise, go on right ahead, man. Good to have you here, brother.
Hey man, yeah, appreciate it. Yeah. Yeah, I heard your bits of what y'all were talking about, and I like to play a little devil's advocate, and I'm actually still not
Premise,
full.
you able to hear me?
Yo, can you hear me?
Am I good?
Yeah, he's speaking.
Yeah. Oh yeah, I was
Oh
saying maybe
man,
Wabi
yeah,
can't hear
I'm
me.
not able to hear him.
Wabi said he can't hear me, guys.
Hey, Premise, drop down and come back.
Yeah, I can hear.
Sounds good to me.
Wabi can't hear you as a co-host, but I think the speakers in the crowd can.
Kim, are you speaking? Kimchi?
Okay, he can't hear the speakers either. I'll come back to him.
Hey, can you hear me, Wabi?
Yeah. I can hear you. Is it something on my end?
Yeah, it might be something on your end. I think a couple people were speaking that you couldn't hear.
Mic check.
Okay. I'm gonna drop.
Mic
You're
check.
good
Mic
now. You're
check.
good. Yeah, you're good now. You're good now.
Yeah.
Sorry, I
Can you
think.
hear me?
Yeah. You're good.
Yeah.
Forest is good. Premise is good.
Yeah, I guess I kind of wanted to pose a question since in earlier talk we was talking about the unemployment, and a lot of people know my opinion on unemployment. I think it's a little tougher than it's been. Stuff like gig economy has obviously changed a lot. You were talking about how people aren't going back into the offices. I agree with that sentiment too, and that is going to hurt. I believe also commercial real estate and such. And I think a lot of people are forgetting some stuff though. I hear a lot of people talk about specifics, but then when I look at the economy, if we're talking about trying to get unemployment, if unemployment going up is going to be the narrative, I just don't see it coming. Other than the gig economy, we also have a $1 trillion infrastructure bill that's going to start creating jobs here in 2023. We got a chip plant being built in Arizona. We got Intel, who's going to be building a new chip plant in Ohio. These are going to be job creating events that the Fed, while he's raising rates, you got a president who's over here creating jobs. So I keep looking at it, and I'm looking at unemployment, and I can go to the unemployment rate, and I can tell you here that we're still at lowest unemployment rates we've had since the 60s, right? And I believe it was 2020 or 2019 up until this point, this 3.5. Back in 2008, unemployment was about 4.6% when the Fed funds rate were at these same levels at around 4.4, 4.8, etc. Right now, we're at 3.5%. Unemployment is not really moving. We're seeing some claims come in, but those claims are to go look for jobs. When you get first laid off, you do apply your first week. We're hearing about the layoffs, but then they go get a job. That's why unemployment ticked up and then ticked right back down. So I kind of want to see what people were thinking about that. That I think a lot of people ignore that there is stimulus in the economy and the infrastructure bill, $60 billion chip bill, $1 trillion infrastructure bill. Those infrastructure jobs have not started yet. And I just really think a lot of people think, hey, unemployment is just going to tick up magically out of nowhere, even though there's been no signs of that. And I think it's going to take a lot longer than people realize, especially when you got a president who's spending money right now. And of course, he could turn back on the student payments at any time, or he could also just forgive them at any time. There's a lot of stuff. I think we look at the Fed and stuff, we forget about the real economy. The jobs are strong. There's a labor shortage. They're creating jobs with an infrastructure bill starting this year, a chips bill, all these different jobs coming back to America. If anything, we have a labor shortage, and that's our biggest problem. That's kind of what
There's,
I'm feeding here.
there's two things I could say to those points regarding labor. One, a lot of the layoffs were tech. Tech is not the average wage, it's significantly above average. Someone getting 250 a year in whatever state, I mean, you could easily get 250 in a high-end tech job in Texas. Obviously, New York City, that's not the most extravagant of a number, or even California for that matter. But the point is, that's a good reason why unemployment insurance didn't really kick. Someone making 250 isn't really that interested in unemployment insurance. The odds are they're just going to hit the labor market and see what they could do in that regard. Another major consideration is the size of the labor force. The labor force is smaller than it's ever been, I think. I believe that's the actual metric. One half the population of the United States does not work for one reason or another. And there's countless legitimate reasons to not be part of the labor force. My wife's not part of the labor force, and so on and so forth. But I would argue strongly that we have a crisis we're currently in an unemployment crisis. There's not enough labor. And the complexity is the types of labor that we traditionally think of for productivity. And we're in desperate need of a revolution of redefining what productivity is. That's a good part of the narrative that I see for the future of digital, Web3, crypto markets, new ways for the population to actually contribute to organized productivity, not necessarily mining or manufacturing or anything we would consider more so a traditional type of employment. Ways for the housewife or someone who's taking care of children to also contribute to organized productivity. This is greatly represented in the stability of the nation. The psychological well being of the nation is so dependent on people contributing to organized, productive activities. And when people are not, psychological well being tends to decline, which is very much, I'm sure, what everyone sees is occurring
Yeah.
in
In addition to the lab or the labor employment thing, it's also not that people aren't going back to the offices. These entry level analyst associate jobs are disappearing en masse because of automation, because of language modeling, not AI. Those slide deck monkeys, those copy pasta regurgitation jobs are prime targets for AutoGPT, ChatGPT, and so on. It's like if you're an entry level employee right now, you have a very short window of time to reach mid level competence, or you're gone.
Yeah, that's another thing. Like, and just to kind of talk about specific like numbers. So going in before COVID hit, the United States had 60 million employed. Um, basically, or no, sorry, I had it backwards. We have 60 million employed right now, give or take a little bit. Before COVID hit, we had 63 million, right? And so, like, the unemployment number that they actually tell you, like the headline number, is not the whole truth, right? Like, because like right now, you could say, hey, we're at like almost historic level unemployment at like 3.4 or 3.5 or whatever it is now in that zone. But that doesn't tell the story, because I posted something else in the nest. Like, I've had this feeling for at least 4 or 5 months now that the unemployment numbers are masking the coming recession. Because everyone, what that individual just pointed out was like the job market is 100% right, with like the unemployment number being super low. More jobs are going to be coming. Um, and all those things. But I think that is why a lot of people are in doubt or basically fading the coming recession, because ultimately, this is how all soft landings go, right? It appears to be a soft landing until it's not, right? You basically have unemployment absolutely stable, and then all of a sudden it just starts ticking up, right? So like unemployment is a lagging number. Because the unemployment numbers don't even really have those all those tech people that got fired even in November yet, right? Because they got like probably a 3, 4, 5, and even 6 month severance package, where they're not even filing for unemployment until that is over, and that's if they haven't even gotten another job yet, or what they're doing if they're just hanging around. So I don't think we're going to see even those first wave of layoffs in tech show up in the unemployment number until probably June. Um, and so that's a huge thing, right?
So,
And on,
so uh, just a quick note on the June thing. So, if you're a recruiter, you know quarter two, quarter three is prime time for recruitment. So that's when
yep.
you really figure out if people are pivoting from their
So
careers, from their current place of employment, and everything.
So
Yeah.
I understand what y'all are saying, because I understand some numbers could still pop up, but then I would counter with this, that the gig economy is offering $1,400 bonuses for people to come drive for Lyft and make 70 a year.
Yeah,
That
no,
the
but
chips bill is still going to create a bunch of jobs averaging over 70 a year, and so is the infrastructure bill. The infrastructure bill is probably going to create at least 500,000 jobs with those type of payments.
yeah,
We're talking about still jobs coming into the market, right?
but the thing is, though, we have just went through one of the biggest labor shortages in our generation. We can talk to why that existed, like not like the worker participation number, but the actual people that the what they use to calculate unemployment. Whether it's basically all the free money that was given to people and they didn't need to go back to work, and so talent just stayed out of the job market altogether, whether it's the changing in the training of the job laborers that didn't have the correct skills. But nonetheless, we went through an extremely tight job sector phase, whatever you want to call it, over the last 3 years. And employers, and like I have my own anecdotal experience where, especially in tech, it has been near impossible to score highly trained and highly skilled individuals without literally blowing out job offers. Like, I mean, just like literally giving them ridiculous numbers to even land and get them in your company. um, and they've just spent 2 years trying to hire employees. And so they are not trying to fire anyone unless they absolutely have to, because they know how hard they work to even get the workers that they have. And normally, how things go in a recession is people do not fire people until earnings go down. As soon as earnings go down, then they start firing people. And we have just started to cross the hill or go over the precipice of earnings starting to actually show weakness and basically start to go down. And so like all we've seen so far is companies that overhired, that basically were cutting fat out of their organizations. The tech is, and not just tech, but growth in general. They basically hire when the cost of capital is basically zero. They hire is throw as much shit on the wall to see what sticks. And then as soon as the cost of capital and things start to shift, they start to cut all the blow, right? And that's what we've been seeing since November. The tech companies seeing the coming recession and cutting all of the bloat, but the broader economy doesn't work like that. The broader economy doesn't cut people until they absolutely have to. And that when they have to is when earnings start to actually weaken. And that's what we're going to see going into the summer. And so I think we're going to start seeing over the next 2, 3, 4 months, you're going to see those unemployment numbers start to actually tick up.
You
Going
know
into
when the broader economy starts to see those numbers tick up significantly is when banks aren't offering the term credit for net 90 and net 30 for companies that have inventory to cover employment for that period of time.
In 2008, what was it? We were around 4.8 or something. What's the number that? What's the number? What's the magic number? Is three? We go from 3.5 slowly to 3.9, back to 3.8. I don't think that's a crazy. Is it over 4? Is it higher than what it was then, or is it lower than it was then? Just speaking on the labor market specifically, what's y'all thought on that?
in 2008.
Yeah, well, yeah, I think unemployment and stuff during like right before the recession, it only ever got as low as 4 point something before it skyrocketed to 9. It wasn't low. Where we are now, we haven't been this low since like the 60s, I believe.
Yeah,
Don't
so
don't quote me on that.
we were this low pre-COVID, obviously, right? And COVID was kind of, you can call that an outlier, and we're roughly a little bit higher than I believe pre-COVID levels. But the last time, before the GFC, I believe they're at like four and a quarter, around, and then it boosted up to 10%. Um, and I don't think like if you it doesn't take a genius. Like you could almost know nothing about how the job market actually works. And if you look at a historical chart of unemployment, you see the waves, right? You don't see it it's never flat. It's flat for a period of time and then it goes back up in cyclical movements and then goes back down essentially, right? I forget the stat that I heard the other day, but it's like if unemployment ticks up, I forget what it was, if it ticks up a certain amount, there's never a time where it's not ticked up another like 200 bips or something. I forget what that I'll try to find that stat, but I don't think this coming recession is going to be one where we see 10% unemployment. Like, let me just put that out there. Like, I would be shocked if we get above 6% unemployment, right? The Fed says that they're targeting for, I think it was 4.25. They want to get unemployment to 4.25 to kind of get the structural inflation down. But we always know the Fed, they always it's always it's overshot, right? So I would be in the camp of expecting to see unemployment in this recession probably from 5 to 6%. Just randomly throwing that out there, just because of like all the things that one guest said about how tight the job market actually is out there, and all those reshoring of the supply chain and all those infrastructure jobs and the investments that are being put into like infrastructure, bringing back chip manufacturing, all these different things, it is structurally inflationary over the next decade, and that's why I think unemployment won't go over 6% in this recession. Um, and you can surmise what you want from that, like in terms of like how bad the capital markets are going to decrease in this coming recession. Obviously I believe the United States is a lot way more better position than Europe per se, right? Europe is fucked for lack of a better words. They're fucked. They're actually probably going to be entering the recession first, and it looks like they already probably are in a recession today. Like their GDP is like zero or like close to the zero bound. And like you have England. England's inflation is still like 10%. Like that's insanity. And their GDP like never actually really recovered. So they're up shit's creek, that's for sure. And Germany, they just posted macro numbers the other day, I believe, of their PPI, surprised -2%. It came in 2% lower than what they thought it did, and that's huge. That's massive. That's like a massive deflationary surprise. Meaning that inflation all of a sudden is like nowhere near what it was, and that's a sign of massive deflation, in my opinion. But the United States, I would be absolutely shocked if we get out of the summer without being in a recession. But I could be wrong. I've been wrong before, but I would be shocked if we get out of the summer without being in a recession in the United States.
All right, so we're gonna go on over to Will's outlook to give his outlook, and then after that, out of respect of the rotation, we're gonna go to fee capital investments right after Will's outlook. Will, give us your outlook, man.
So I'm going to start off by coming at premise. No, I'm just joking. No, but I do want to bring up the topic of gig economy, right? I, I I hear that word a lot, and it's not just from you, premise. But I want people to understand sectors too, right? And when we bring up something like Lyft, for instance, $1,400 per driver, yada yada, it's an incentivizing. I would say it's incentivizing people to come work for a company that offers nothing, right? And that's really what it is at the end of the day. It's a services sector with no benefits, a services sector with no protections, and a services sector that has a revolving door of employees. And that's really kind of the way I see Lyft, as well as many other, I would say, predatory type models, business models. And I call it predatory type business model because of the way it's set up. It's set up to have employees as contractors versus employees. And, that basically when you're set up as a contractor, you really have no rights and you can be fired any moment. And that's why I call it a revolving door type business model. There's a lot of those out there. So we can call it Giga. We can say they're surviving, they're making it, they're offering all this money. But I think they're offering this money because of the predatory nature that they have on their employees, and they have the available capital to be able to do so because of the way that they prey on their employees. That's a lot different than say something like Facebook, right, or something like Google, kind of like what Magoo was kind of, I would say, leaning towards as an example, where we saw Facebook go through round after round of 10,000 employees after 10,000 employee layoffs. And then we saw Google kind of follow through in the same manner. We saw Twitter follow through in the same manner. We saw Tesla follow through in the same manner. But services sectors continued to tick up, right? And I think services sectors going into summer makes sense to tick up. So I think those incentivizations will happen going into summer, but as Magoo has said, I think that will also kind of start to tick down midsummer, going into late summer, going into winter, and that's where we start to see that move back down and that retraction in that services sector, and that strength that people see in the services sector. I think then kind of starts to alleviate itself and kind of we'll say eat itself at the end of the day. So I did want to kind of touch base on that, but I'll give you an opportunity, Premise, to go ahead and respond. It looks like you want to respond to that.
Yeah, I love you, brother. I didn't. I kind of got a response. First I would say, the main reason why that's important to me, them offering those bonuses for people come over. One, my homegirl, she was a data analyst for a marijuana startup. She got fired. I think AI assisted to it, but she, they caught her with something. She thought it was cool. They fired her. She immediately went and started door dashing in Boulder, Colorado. She averages about 30 an hour. Two, Uber Eats told her she could take online classes paid for by them if she's a diamond driver, etc. So they're actually offering some perks and benefits, maybe nothing crazy, but something a college kid could do instead of flipping burgers for 15 an hour at McDonald's or less. Three, what we do is the gig economy, right? We all connect online, we run different services, businesses, etc. You know, those type of things are also gig economy. The gig economy is it's just more than kind of DoorDash. It's just kind of one thing I was getting at. But there's still so much money in it, and so they don't count when DoorDash is saying, "Hey, come drive for 1,400 bonus." They don't count that as now hiring, right? Like, I don't think I don't think any economist, I don't think the Fed, anyone looks at the numbers from the gig economy. And I think about 20 to 30% of people kind of participate into it. Those are the numbers that I'm seeing. So I just think it's stronger than people. It's stronger than people are giving it credit for. I think a lot of
It's
people are kind of underestimating it a little.
it's just really hard to do that and to take those into the consideration, the models, is because a lot of those gig economy jobs, like, and I think gig economy honestly is very too big of a broad of a label, because you can throw almost everything in the sun at this point in services under the gig economy. So like we got to be specific. But a lot of those jobs that we're talking about, I'll call them temp jobs, right? Again, I don't mean temp in the fashion of like a negative connotation. I just mean they're not permanent employment jobs. Whether it's DoorDash, Uber, or even like people that are doing call center work from home, and they're going in there, right? Those are like in the financial industry, we like to define money by, is it sticky money or is it not sticky money, and we want to create environments to have sticky money. And this is a perfect example for employment. Like, these are not sticky employment numbers, right? These are the very first jobs that go away in a recession or any kind of economic downturn. Is those immediately go away, like immediately, and there's no repercussions to the employer because they're on contract base or whatever you want to call it. Whereas all of a sudden, if I don't have $40 to spend to buy one sandwich on DoorDash because of the fees, like, I stop doing that. And that individual that works for DoorDash, or not works for them, but is a contractor, that liquidity, I'll just call it liquidity, goes away instantaneously. Like, literally, it goes from people are spending money on Uber and DoorDash and all these things, to instantly not. Like, it's literally like a switch, right? And that's how recessions work. People go from all of a sudden they're spending their money, they're basically using their credit, they're spending money, and then all of a sudden one day it just stops, right? It's kind of like a psychological effect where it slowly starts to tick down, where people start becoming more conservative with their money, and then all of a sudden, boom, stop, right? Um, and another thing with the gig economy, that what people aren't talking about, and I hate using the word gig economy, is it's more than just we're just that's just talking about it on the employment side. The consumer side as well, is they're pushing the gig economy, because like not only are the gig economy about temporary jobs, it's about temporary services. Like, for example, Uber. Like, it's like you're not buying a car anymore. So there's another side of the story to the whole, like, benefited the gig economy. So instead of buying, like, so yeah, you're spending money on Uber as a service, but the whole car industry has to change because no one is buying cars anymore, right? Or you can take this to whatever other thing that's in the gig economy, right? Oh, someone's buying a sandwich on DoorDash. Well, that means that someone's not buying groceries, or that someone that's not going to a restaurant. So it's not just imagine like a magically new GDP and new money being basically created. It's you're taking that already existing stuff and just moving it into like a different form or a different fashion. Sure, there's going to be efficiencies that are added because of the gig economy. Like, for example, that's like Kathy Wood's whole fucking thesis about robo taxis and Tesla, is that, like, okay, well, no one's going to be buying cars, but like we can create this $5 trillion robo taxi economy where literally anytime that you need a fucking car, it's at your door and it's driving you, and you don't need to buy one. Well, that's 5 trillion, and I'm not saying that's true because some of those numbers are just fucking asinine. But ultimately, like, that's five. Is that $5 new trillion to the global economy, or are you? Or is that money that's being taken away from certain sectors, right? Like, there probably is net. It's probably net positive, like in terms of like the GDP, but like you're taking it away. So like when people just say, "Oh, gig economy," like that is they're taking that from somewhere. It's not just like the
Oh,
economy is magically growing.
Oh, I use it. I'm staying in an Airbnb an entire month here in Puerto Rico while the owner is making money, living somewhere else. Like it even created a new housing sector where Airbnbs, you had all these people, which I'm waiting for those guys to fold. I'm with y'all. Like I know there will be a pressure point. What I'm telling people, since I use it and I see very busy and I can open up these apps in Colorado, it says very busy, plus $3 per order across the board. I actually view these things. It ain't now. There's still a
I
lot of demand. My homegirl literally just replaced her entire job with the gig economy. She loves it.
I
She does
I,
three different things.
I want to weigh in real quick, premise. So like, I want you to understand. I know exactly where you're coming from too, right? I'm talking about both sides of the coin when I'm talking, so I'm talking out both sides of my mouth in a sense. Is I'm understanding that people are seeing strength in the services sector. Don't disagree with that at all. It's there, right? But the services sector will be the hardest hit once a recession sets in. It will be the bottom of the barrel once the recession sets in. And I think that's the part that people don't really get to or understand. And yeah, what we do too is a service, right? Premise. What a lot of people do on Twitter is a service. But that service will stop being viewed. That service will stop being used in a lot of cases. I think in a economic downturn, and that money that's being allocated to these services sectors will then be allocated towards things like going and getting groceries at the store and getting gas and paying rent, and they'll stop being allocated towards getting a lift to go down to the local movie theater with your boyfriend and so on and so forth, right? That's basically where that money will rotate in a recessionary environment, and that's kind of the point that I wanted to point out of all of this is that like while that services sector is strong right now, that can tick down a lot faster than what people think it can.
Well,
Once we start to see a real slowdown.
don't forget as well, like the headline unemployment numbers usually don't peak, like the highest unemployment. They don't usually peak until basically after the market is already bottom, right? Like I think the number I think is 6 months, right? Like some of the things that are the last to bottom in a recession are unemployment in real estate, right? Like in terms of like so this is the thing. You're not just going to see unemployment go from 3.4% to like 6%, right? Like unemployment is going to reach 6% near the end of the recession. Like that's the thing. And so when a recession usually hits, like the unemployment peaks like at the end of the recession, right? That's the whole point. And so like if you're looking, in my opinion, like if you're trying to look at the markets and make any type of considerations and trying to actually make a future bet, looking at unemployment is one of the last things you want to look at, because at the end of the day, that unemployment is a backwards looking number to begin with, let alone in a recession, right, where it's going to be the last thing that peaks. So like if you're trying to make any assumption on any bet that you're making in the market, like unemployment should be the last thing that you're looking at.
Oh
Hey,
no, I trade charts. I trade charts. I don't even use macro to trade. I'm just talking from an
Yeah,
unemployment
I don't know if
standpoint. I like
that's
looking at stuff like CPI. I've been calling CPI heavy. I call CPI good, and I've been saying that unemployment wouldn't tick up fast. I do think most people are surprised it's still at 3.5.
the right.
does Uber and Lyft and the overall gig economy contribute to unemployment insurance? They're contractors. So I think that's an interesting potentiality. If you
That
have like 10% of Ubers, that capital flow isn't there anymore. Do they even have the option to apply for unemployment insurance? So it might not even register in the metrics.
And I'm glad we're here, joined by Uncle Joe. Uncle Joe, I want to welcome you up, man. Good to see you. Right when I saw you, I simply had to bring you up, man, because I don't want to be in a situation when we meet up in Miami, you play the aggressive, and when we play basketball. I know you're 6'5" and you're a beast, sir, but I want to welcome you up to the stage, and also for Mr. Jacobs, Neil Jacobs, man. I sent you an invite to speak once again. Pardon me, sir. These conversations, like when we have these roundtable conversations, some of us tend to have long-winded responses, but we appreciate that here at Because Bitcoin, and we want to welcome you up here if you're able to. And yeah, it's good to have most of our team up here. We have Will's Outlook, who's new to the team, and of course we have
Snorlax and Premise joining us in this conversation with Magoo, who I've seen him here across these Twitter Spaces for almost a year now. So if you guys enjoy this content, feel free to follow us and also follow Magoo. He's a pretty funny and entertaining guy, but an individual that's been in markets for a while and has a firm understanding of how these macro events take place. I mean, since I've known him, he hasn't been wrong with any of his major predictions. So, you know, wisdom. Someone is truly filled with wisdom when they back up their shit. So we always appreciate that, man. Always appreciate that. So, Uncle Joe, welcome on up, man. What do you have for us
Yeah,
today,
no,
brother?
thanks
How
for
you
having me
feeling?
up, Bobby. It's awesome to always talk with you guys and Magoo and others. I was just going to say a couple things. Number one, to the gentleman who was speaking, Captain Rational, they're under the COVID relief program, on the pandemic unemployment assistance, they expanded unemployment insurance to cover in many states, and also there's localities that have done similar expansions for gig economy workers, including Uber. So they are covered under the current operating law that still extends out, believe it or not, from the COVID pandemic, which is remarkable when you think about it. So the question is, what I have to look up whether that will still extend out if there was a recession later this year. It may have lapsed or may lapse at the end of 2023. But I would not be surprised if you saw a similar expansion given the proliferation of gig economy workers, and particularly at the state level in places like Illinois. I know that will expand to cover gig economy workers. But the larger question is, when you talked about employment, Michael Cantrell's framework, I think, is correct on this. Magoo, to what you said, like if you're charting equities and your only goal is to sort of catch the big downside move in equities, rises in unemployment are actually extremely coincident with the first initial rises in unemployment. When unemployment starts rising rapidly, equity market sells off, and it sells off really hard. So that's one historical thing to look at if you are trying to chart when the big capitulation will come in the equity market. Generally tends to come with the proliferation of, or with the prolific rise in unemployment.
Yeah, it's when the bulls actually capitulate that there actually is going to be a recession. Like we've been in this, and it's not so much what the under or the headline number of unemployment is, it's the delta on how fast it's changing and their ability to finally accept that a recession is on the horizon, and that's when
Right.
they
And
capitulate.
now, like if you're
um
looking at it right now, okay, if you're trying to time that capitulation of the bulls, we're still a ways off. You don't see that in the labor market data right now. You see mild increases. You've seen some beats recently. So like yes, by definition, a recession generally begins when the unemployment rate bottoms and starts to rise. That's generally the beginning, just how they measure inflations, or excuse me, recessions. But to pick the point where equities roll over, you want to see what you're talking about. You want to see the delta, the rise in unemployment very rapidly to sort of be coincident to a downturn in the equity market.
yeah, I guess the at the end of the day, I guess the not the proof in the pudding, but the like you're gonna have to be early. Like you're not. It's not gonna be a writing on the wall, right? Like even when the unemployment starts to tick up, there's going to be people that are like, "Oh, this is just a normal flow," and then the next print is gonna be something stupid, where it's gonna be so apparent that that's when the
No,
capitulation is
well,
gonna
the
happen,
data.
right?
So I think let me rephrase and tell me if you agree with this. The official data sources that will be published, those will already be known to the market before they get published. And I'll tell you some example. There are firms out there, major research analyst firms that monitor Google search trends. They have their own proprietary models on how they gauge what the official numbers will be. So you'll start to see that price action before the official numbers are already being reported. But that's not to say that once the official numbers are reported that you won't see further downside. You'll just see there'll be a cascade already of selling that has occurred because people have sniffed out that the official prints are going to be pretty bad.
Yeah, yeah, exactly. Um, when and I guess the $1 million question is like, when is that going to happen stateside? Because like I don't fall into like the camp of no landing or soft landing. I just really don't think that's viable. And to me, the question is like, when are we going to see that uptick in unemployment? And I have my own anecdotal numbers and things that I'm looking at that's not individually to one company, but across many companies, and how I'll just say executives or boards are looking at things and how they're planning for the next 12 to 24 months out. Um, that, like I said earlier, I would be shocked if we don't see an uptick
Well,
by the end of the
you'll
summer.
see things
Um,
before that, right? Prior to unemployment rising, you see two things consistently. You see delinquencies and defaults. They always rise, which makes sense, right? Like from a demand perspective, once people start becoming delinquent on their debt obligations, then that destroys further and further buy side pressure. Then that contributes to workers being laid off because producers and employers decide we don't need as much staffing. So the delinquency rates are really the first sign. This is why most people got the trade wrong in 2006, leading up to the housing crisis, because you saw delinquencies start to skyrocket, but the real estate market hung in there for a while because that delinquency rate rising takes time to filter through into the actual home builders and other aspects of the real estate market. Similarly here, like before you see labor soften considerably, you're going to see delinquencies rise necessarily.
do you think that might be skewed a little bit this time around because of how, like, those policies that you just mentioned about unemployment insurance? There's, you can name your COVID relief
Student
fund
loans, like
or
everything.
whatever,
Yeah,
student loan, whatever it's student loans, whether it's basically people not being able to be evicted and not paying. Like, you can name the program. Like, do you think that skews that view any
yeah,
at,
absolutely.
at
This
all?
is why we always tend to fight the last war, right? And again, like you can look at the Goldman Sachs data. If you don't believe me, go Google it. I've tweeted it out 100 times. There's still, from a balance sheet perspective, consumers still have a ton of cash left on the sidelines in terms of excess savings. Now, everybody posts this chart, and this is really key. If you see this chart posted, point out how it's wrong, of how the savings rate, meaning new savings, is falling rapidly. But that says nothing about the excess amount of savings, the accumulated savings that have taken place since the pandemic. And what it shows you is that by Goldman Sachs estimates, about two thirds of this excess savings will be depleted by the end of the year, by the end of 2023. So that tells you there's more of a runway before this hard landing. That's all. It's not to say there isn't going to be a hard landing or there isn't going to be, a crash of the plane. It's just saying there's more of a runway. And that's the thing you have to take into account. Like, I think most people have underestimated just how much freaking cash got floated onto household balance sheets. And even with inflation in real terms, you can look at the Chase data, Wells Fargo has similar data for their checking account customers. They're elevated from 2019 levels on a real basis, meaning adjusted for the high price increases based on CPI. They've still got cash that needs to be completely depleted before you see the delinquencies rise, and all these other programs and student loans and all these other things. They just tell you that this thing can take longer than people have ever, I think, anticipated.
Do those numbers from um GS, do they actually break it down in terms of like the aggregated amount of
Yeah,
per
let me
household, or is it just a
so so
large
the
sum
so the
number?
JP Morgan Chase data, that's checking account level data, that breaks it down by the household. But let me post in the nest here the chart that I'm referring to that talks about excess savings, um, for overall. So here it is. This is the right here. Okay, so give me 1 second. There you go. Okay, Goldman Sachs estimates that households have. This was a tweet from January, so it's a little bit outdated. Goldman Sachs estimates households have drawn out about 35% of the excess savings and will have spent around 65%. In other words, two-thirds, which is what I said, by the end of 2023. Look at that chart, and tell me how it's going to all go to hell in the next month.
Can I jump in here?
Yeah, I was gonna bring it right to you, man. Welcome to the spaces, brother. Go on ahead, man. Good to
Thank
have you.
you. I appreciate the invite and loving the conversation. A bit sick, so I'm going to keep this short. I do want to back up Mr. Magoo here regarding, because I am up in Canada. As people rotate out of their low interest rate situations, they are accepting these longer terms. Basically, what's going to happen here is you're pushing out home ownership decades out, and you're just going to spend your life paying interest to these banks. So home ownership is pretty much dead in Canada. Um, I'm trying to figure out this inflation rate story. I don't know if we've peaked yet. I've been looking at these short-term bond rates, the 1 year, 2 year. Typically, they mimic the federal funds rate. And typically, when the short-term bond rates peak, we get a recession about a year, maybe more, maybe less from that point. So we are kind of at a vertex now. But at the same time, we've had this banking situation, which is supposed to be deflationary. But at the same time, we've had the news of these OPEC cuts that are supposed to come next month. So if they actually follow through with that, that could add inflationary pressure with the energy prices making everything expensive. So I don't know if they can actually stop raising rates if their mandate is 2%. And if they want to get to that 2%, they should get there sooner than later, because the longer they wait, the people are going to get entrenched, right? They're going to change their behavior for the higher rate situation, right? So I don't know how that's going to work out. Um, and we also, regarding the labor market, we just had this article from Zero Hedge saying they dished out 23 billion less in tax receipts. So how does that go with the tight labor market story?
Another thing as well is that a lot of firing and hiring also has tightly is also tightly coupled to like just corporate earnings, right? It's not just about delinquencies. It's also about the margins that these corporations are making, or not making, for that matter. Um, and I believe there could be a world where at the end of the day, the unemployment numbers can go up, even with that chart that you posted, Joe. That the basically the per family household of like their savings, and how the trajectory is basically going to the end of the year. That could accelerate greatly, because if corporate earnings start to decline, and we've seen some weakness, we haven't really seen like a full on rollover yet, of corporate earnings, at least in the public sector. We've seen inventories rise and some early warning signs. But if that starts to roll over, and I said that earlier, that's when a lot of the real layoffs happen. Right? We've seen the tech layoffs because they've cut all the fat starting in November because they see what's on the horizon, so they've been cutting their fat. But we haven't really seen those numbers even really being applied to the unemployment number at all. And on top of that, once corporate earnings actually start to roll over, and you could say this is a chicken or the egg problem, but there is some signs that corporate earnings are starting to, whether it's going to be next quarter or the quarter after that, where it's kind of the writing is on the wall that, hey, look, like we're in an earnings recession or whatever you want to call it, or even that they've started to roll over. That's when you're going to see layoffs, not just in the tech sector, but from the actual industries, so like services, industries, manufacturing, right? Because if you want to look at like the manufacturing numbers, right, like the manufacturing numbers in the United States, those are fucking in the toilet. They've recovered a little bit, but those are still in the toilet. And so that is a leading indicator where I think we're going. But I do agree with Joe that like the consumers does still have a lot of money on the sideline, but I think that can accelerate to the downside quickly if corporate earnings go down. And you might think, well, if these people still have the money, how is corporations going to have less earnings? Well, it's because of it's sediment, it's psychology, if people believe that they're in for a hard time or going to be in for a hard time, they're going to tighten their pocketbook
Well,
and they're going to stop spending.
yeah. So let's just talk about that. So if you want to look at historical examples where consumers have been relatively healthy from a balance sheet perspective, and then that has deteriorated rapidly, what tends to occur in those scenarios is you have some sort of exogenous shock, like, for example, extremely elevated oil prices that can put tremendous pressure on both businesses and households and every element of the supply chain. Or, for example, in 2008, if you want to draw that analogy, a systemic banking crisis that can hasten the activity of employers and otherwise sort of cautious business participants and say, no, we have to cut staffing now because there is an exogenous threat that is changing the game. So many people, I think, suspected that could have resulted from SVB and Signature. I think that, but we know now, it's 30 days later, that was overblown, right? But that's not to say that you can't have some different exogenous shock. For example, things like commercial real estate or other weakened elements of the economy, and that can rapidly cause staffing decisions that would have been put off for another 2 or 3 quarters to say, nope, we got to do this now. It's happening now. Keep in mind, unemployment began to rise rapidly in 2008 as the banking crisis started to accelerate. And that's not a coincidence because people saw the writing on the wall and they said, no, we need to make these decisions now. And suddenly you see this explosion in unemployment, through the middle of the latter half of the year.
Will's outlook. Go ahead, man.
Man, I got so many things.
Give us your outlook, bro. Give us
So
your outlook amongst the 10 or so different outlooks, man.
one thing I wanted to touch base on, we're far past it, but what you were referring to there, Joe, was the CARES Act. I believe the CARES Act for contractor employees ended in December of 2020. Could be wrong on that, but I'm pretty sure that's when it actually ended, and that was what covered employees that were contractor employees under what they and just so you know, premise, it was called the gig economy, by the way, too. All of them were under that label called the gig economy. Um, so I just want to throw that out there also, just so people are aware. So basically, contractor workers under the gig economy. I wanted to get your thoughts also, Joe. What do you think of oil? What do you think of where oil is and how it's sustaining and holding the strength? That's my opinion. Maybe
Yeah,
you
no,
see it
I
differently,
think
but
oil's a basket case. I mean, I think oil's going lower because I think we're headed towards a recession. I think the oil chart, you had this bounce that you saw from the Saudis, saying they're going to, once again, cut production. And what have you seen since then? Since you had the bounce, which had gapped up on the 3rd of April, right? We've basically been, and we went higher for, a week or so and then straight down mode. So I don't really think it's showing particularly strength. I think it was oversold, due for a bounce, and I expect lower lows on the way in the remainder of the year.
That's just a sign of deflation in my. The reason why they actually even did the cut of production is not because they want to screw the United States. Like that's the way that it was sold. It's like, oh, OPEC is taking it to the United States and fucking them once again. When in reality, they're just actually preparing for lower demand, right? And this is what Joe's saying with oil prices continuing to go down. They're just trying to adjust the supply to where the demand is going to be, not to where it is. And that's them projecting out that the demand for oil in the future is going to be lower than it currently is, right? And that's just them. That's deflation, in my opinion. Like
that,
that's them projecting deflation into the future.
that's kind of what I was hinting to, Magoo. Maybe I didn't voice it well. It's more or less like it doesn't seem like they're trying to pressure oil up as much as it is just trying to keep support under oil. When I said strength,
Why would you have to keep support under oil if it was truly scarce, right? I mean, unless
it's
it's
not
their efforts are proving the case for recession. I mean, you would not be engaging in that activity of cuts to support the price if there was
exactly.
true demand. If the China reopening story were legit, you would not have to do that. So I don't buy it.
Yeah, that's the biggest. Yeah, that's the biggest horseshit story of I think the quarter of, or maybe even last quarter at this point, the China reopening story. that's fallen flat on its face. Like it is like literally like they reopened and how they're supposed to be this huge gluttonous of commodities and it's going to add to global liquidity. It's been like not only has it been lackluster, like I would say it's been an upright disaster for China. Like they've literally like their economy like it's like when those little rockets you get as a kid and you like pump them up so much full of like water and you try to launch them and it goes like 2 feet in the air and falls flat down. It's like, oh, okay, that's what this is.
You will never hear someone say they're stacking yuan, like not in this lifetime. And also, so one of the biggest trade fairs in Asia just concluded. It's called the Canton Fair, otherwise known as the China Import and Export Fair. The attendees there, without hesitation, have admitted they're mainly catching up from all the shipping backlogs that have hit every port worldwide because of COVID. Summer may simply be when the pain begins to show to a point where it's undeniable, but there is a reason we're seeing dead cat bounces, whether in the indices or in crypto, because not only is it the year of the cat, but a lot of the industries are simply playing catch up from the past 3 years. Like we have people who have firsthand and anecdotal experience in construction and real estate that have already made points about how less and less people are building or signing new deals. And I work in merchant services, so credit card payment processing, all that. And credit is killing it because everyone's using credit because they know like credit's not going to run out. Because if credit dies, then the current system dies.
What do you mean the year of the cat? What was that?
Joe, it's the year of the cat.
Oh, is that? Sorry, I'm not familiar.
Oh, you know how there's like
Has to
year
be
of
a
the
voice
dog?
clip. This has to be a voice clip, man. This has to be a snippet for the future. What's
The
the year
Chinese
of the
calendar,
cat?
man.
Oh, the Chinese cat. I'm
No,
sorry. I apologize.
it's just the calendar. It's not the Chinese calendar. It's the
My
Lunar
my
New
sorry.
Year,
I
not the
didn't mean to be
Chinese New
offensive.
Year.
I'm sorry about that.
No, I'm not offended. They did it.
You're good. Yeah,
But
I don't
but
think.
yeah, TLDR, my main point is we're playing catch up. So if you see any industries feeling like they're feeling the heat again, it's not because of anything new.
Yeah, and liquidity at the end of the day, liquidity is going back down again. At the end of the day,
So
we had
um,
that
go
surprise.
ahead, Magoo.
Go ahead, Joe. All right. I was just gonna say we had that surprise of like the drawing down of the treasury and their GL to add kind of liquidity into the system. Then you had China did add some liquidity. China has been adding some liquidity this past quarter, but and then we had the Fed, if you want to call that program that they instituted as inflationary and adding liquidity or whatever you want to do that or whatever you want to call that. But like at this point, liquidity is going back down, right? And it's just that's like literally like if you could pick one chart to literally map global liquidity, like it's literally Bitcoin. Like just look at the Bitcoin chart, and that's like a reflexive chart of like global liquidity, right? And it's no surprise when global liquidity starts to go back down again that Bitcoin basically goes
So
down, right? And it's
So the BTFP that you're talking about in the discount window, we have now chewed up 38 as of today because I just looked at the ODL numbers. We chewed up 38% of the balance we got in March, 38%. And remember, unlike the BTFP, the discount window's term is 90 days. Anything at the discount window has to be repaid in 90 days. So the liquidity, which was predominantly supplied by the discount window before they got the BTFP up and running, that will be gone within another 60 days. So if you just do the math of what the QT they're continuing to do, which they've never stopped doing the actual QT and the passive maturation and not replacing those bonds, you're going to be down to a new lower low on the balance sheet in mid June.
So let me give an example of that real quick, Joe, just for the people who don't understand. So you're in the ocean, right? You have a boat. Your boat sinks. Now you have to swim, and eventually you're going to run out of energy and you're going to drown, right? So somebody comes by on a rowboat and they throw you a life raft. You then sit on that life, not a life raft, but one of those little donuts, right? You sit on that donut until a ship comes by to pick you up, if a ship comes by to pick you up, essentially. And that's basically what the Fed has done with these programs. And that's what a lot of people really have to grasp with the situation. These are just little life rafts, little donuts they're throwing to them to keep them afloat.
And they charge you for
Um,
them.
and they charge you for them. Exactly. The liquidity comes in. It's temporary. It is QE while it exists, but once it goes back out, it's actually more QT because you're getting charged for the loan on top of it. So it's more QT to the economy when the loan is paid back than what it would have been essentially.
If they pay it back.
Yeah,
But
and
but
then
that's not
obviously
in my mind.
consequences if
That's
they
not the
don't.
real story. The real story is this: that for a decade or more, what the Fed's policy was, it had sort of this, one-sided monetary policy where they said, like, when financial stability becomes rocky, we're going to vary our broad tool of monetary policy. I.e., when there's illiquidity in the treasury market, we're suddenly going to pivot or pause or stop hiking rates or stop draining the balance sheet. And I think they've learned from those episodes, for better or worse, and they've commented on this publicly. I'll post a tweet where there was a comment last fall about this exact thing, how financial stability is not going to deter their monetary policy goals. So let me put that in more simple terms. What I've read their policy to mean recently is that they are going to do these sort of surgical approaches, stabilization efforts, new facilities, new isolated areas where they're going to provide liquidity where necessary. They're going to do that on an ad hoc basis if little conflagrations start to fire up, but they're not going to do it in a broad tool of monetary policy. In other words, they can keep rates high. They can keep draining the balance sheet. And if they need to do a facility for the banks, they'll do the BTFP. If they need to do BTFP 2.0, they'll do that. If they need to do a facility for commercial real estate, they will do that. They will deem systemic risks to the financial system and handle with those on a one-off basis without deterring their long-run policy goals, which is a different Fed from what we've seen, I think, for the last 10 years.
Completely agree. Completely agree. Now, at the end of the day, what do they not bail out that could cause systemic risk to the economy? Right. That's the real question of where this
Nothing.
goes.
Nothing, right? Because that's the thing. So, like, you can say that you're going to do these targeted things, but as soon as it comes to something, like, if it is structurally important, they're going to bail it out, right? Like, they don't have a choice because if they let any one of these pillars fall, whether it's commercial real estate, whether it's regional banks, whether it's residential real estate, whether it's private equity, whether it's venture, they've already bailed out venture capitalists, right?
And
Whatever it
this is
comes to, if it's structurally important, they're going to bail it out.
this is precisely why bulls feel the way they do, and that's why I don't blame them for the way they feel. Right? They feel as if they have that support there that will keep them afloat. But I want to really let people understand. Look at price right now and look at price at the beginning of last year. The SPY has not moved. It hasn't moved. We're sitting in the same price range we've been in for a long time. And that should be indicative of people to understand where we are in a market, right? And that tells me that the market isn't bullish or bearish. It's simply complacent. And complacency is not a good thing for a market if you want to move forward.
Bitcoin Tina, I want to welcome you up, brother. Thank you so much for taking the time to come up on stage, man. Huge fan of your personality and all your energy, man. I hope you bring it during this conversation. Very excited to have you on here, sir. How's it going?
It's
Thank you for
good.
joining.
I think people don't fully understand what Joe said, because what Joe said is what I've been saying for a while now. And I think it's really important. And I think he really hit the nail right on the head here. And I think it went over your head, Magoo, whether you like it or not. I think you're wrong.
Tina,
I think
you're just
Magoo,
mad that
Magoo,
I told
Magoo,
everyone that
Magoo.
you told me that the U.S.
Okay,
government had an
Magoo, shut
excess
up.
of
Magoo,
security
Magoo.
bills.
You said stupid shit. Okay, shut up. What you tweeted the other day was dumb and it was wrong. But that's not the point. What Joe said is
Let's get Tina going here. Let's get the old man in his diapers. Let's
what
go. Come on,
Joe
Tina. Let's hear it.
what Joe said, I think is correct. And I think you can get a traditional credit contraction without having um, a systemic structural problem. And I think that's what the Fed is after. So that you get something that actually really wrings inflation out of the system and gives the system a chance to readjust itself and will work asset prices substantially lower. And I think the market's read on BTFP was completely wrong. And I think it's a really big deal and a major shift of policy. And I
Can I?
think it matters. I think it matters a lot.
So let me.
And people are totally missing.
Yeah, let me just read this again because I think it's really critical. And if look at this in the nest, this tweet, okay, which was underreported in my opinion, from October 6, 2022. I'm not going to read the whole thing, but I just listen to this, okay? In considering what might happen to alter my expectations about the path of policy, I've read some speculation recently that financial stability concerns could possibly lead the FOMC to slow rate increases or halt them in earlier than expected. Let me be clear. This is not something I'm considering or believe to be a likely development. One factor that is likely helping to stabilize the system is the existence of monetary policy tools that could serve as a backup source of liquidity in times of financial stress. For example, swap lines that the Fed maintains with other central banks, check that box, have been used effectively in the past to relieve stress in the financial system. I think the availability of these facilities tend to be a stabilizing force at other times. In addition, to help monetary policy, the Fed established new standing repo facilities in July of 2021, one for domestic, another for foreign. These facilities are capable to responding to strains that may put upward pressure on money market rates, but I think it is likely that the mere existence has been a stabilizing force. Along with improved regulatory framework, I believe we have the tools in place to address financial stability concerns, bold and underline this, and should not be looking to monetary policy for that purpose. The focus of monetary policy needs to be fighting inflation. I think that's the whole ballgame right there.
And I
I think I
wait,
think
and I think
I think everybody
no, they
understands
don't
that though.
understand it. It's obvious they don't understand it because you can see the market reaction. So pretty much nobody understands that. What I think this
No,
means,
the
Magoo,
market
just give me a
understands
second,
it. It hasn't
Magoo.
moved.
Give me a second here. What
The market hasn't moved.
Magoo, what this means, in my opinion, is that you can see a long extended bear market where PEs slowly adjust lower as rates remain very high for a very long time, and you slowly suck it's like a large leaky balloon which is going to slowly lose air over a very long time horizon. And I think it has implications for what this market is going to look like over the next 1 to 2 years. And I think you've got bears that are looking for an imminent crash, and you have bulls that think things are going to go sky high. And I think neither of those things are going to be right. And so when you put that together and you start to understand what the shift of policy, they're not going to use macro policy. So let me tell you a story. Back in 1998, around the time of long-term capital management, the Fed cut rates at 3 o'clock in the afternoon on a monthly option expiration on a Thursday. They specifically targeted the stock market. They're targeting the stock market again, but this time on the negative side. They want a contraction to happen, but they want a contraction to happen long and slowly, so it takes the steam out of asset markets and takes the steam out of the
It's
economy
a controlled
without
demolition.
without
It's a
exactly.
controlled
But
demolition.
that's a huge change, and it means you're very unlikely to get a massive fiscal response because you're not going to have a crash. You're not likely to get this big blow up because you're not going to have them. This is a big shift, and people are missing this. And I think Joe is exactly right in this.
I don't I don't think they did well. Some people early on missed this because like a lot of people thought like in a lot of people on the stage is they were fighting this of what literally what you just said, Tina. Like they were fighting this even as early as like 4 or 5 months ago. That was like they were still.
Magoo. Don't be surprised if rates at Fed funds are still in the 5% range come Christmas and the economy isn't in the tank and is just slowly working its way there, but the stock market's 5%, 6%, 10% lower. Just don't be surprised because that's a real possibility. Don't be surprised if that happens.
So I would be surprised if we are still at 5% and the market
I
is
know you are because you're
lower.
expecting a crash. And what I'm telling you is I don't think that's what you're going to see because this is a big shift of policy. And they're
I know,
intentionally
Tina.
doing
I think you
this.
forget. Tina, I think you forget that it was me explaining to you how this is a change in policy back in the early part of 2021 when no one believed me, and that Bitcoin was going to hit all-time highs again because the Fed had was going to come to the rescue. Like I was one of the first people talking
That's
about
terrific,
this.
but that's not where we are at this point. So that's great. That's great that you. It's
No,
great that you sold at 64K. I wish I sold everything at 64K. I could have bought it all back and then some at 16. But that's again not the point. The point is where we are now. So you can pat yourself on the back for it, and that's great. But it's a huge shift,
no,
and
Tina, you've
people have missed it.
Tina, let me finish. I know it's almost your bedtime, but
No, it's
what I was
it's
going
two
to
or three
say
hours. It's
is
2 or 3 hours past my bedtime. I like to go to bed at 6 o'clock at night.
okay, so at the end of the day, like I believe we are in this different regime. Like this whole decade, I believe is going to be structurally inflationary over the next 10 years. And you're going to see this because of just the energy shortages, the overall geopolitical landscape, the Fed being one of those main reasons because keeping rates high this whole decade. And I don't mean like they're not going to keep them at 5% for the entire decade, but they're going to be substantially higher, I believe, this decade than they were last decade, right? Like they do not want to go back to the zero bound ever again. They've realized, as what Joe said, is that just doing blanket statement QE did very little to actually benefit the economy. And it actually created a lot of negative effects, right? And so they don't want to go back to the zero bound and just blanket statement QE. And so they are going to keep a moderately higher
But my point,
rate.
but Magoo, you're kind of you're still,
Let me,
but you're still not
Tina, let
touching,
me
but you're
finish.
still not touching the
Tina,
point.
shut the fuck up, Tina. Let me
If you
finish.
let the economy crash when you can try to have a controlled
Tina, no
demolition,
one wants to talk to you ever because you don't shut the fuck up and let them
Magoo,
finish. Like,
you're
let me
not one to talk. You go on and on even longer than I do. So trust me, you're not one to talk.
All right, first of all, shut up. Okay, let me finish, then you can go off on your tirade. At the end of the day, the rates, like they don't want to go back to the zero bound and they want to keep them at something that's moderately, maybe not historically, but just moderately high, whether it's in the 2-3% range, maybe even 4% range, and just bouncing around those areas. And they don't want to get back to the zero range. That's just structurally because the inflation is going to be high and they have to, because if they try to pull off what they did in the last decade, in this decade, you're going to actually find inflation, which they weren't able to find last decade. And so the regime is different. I think the stimulus this decade is not coming from the monetary side. It's going to be coming from the physical side, like the treasury. And it's not, and that's not happening in the next year or two because of other reasons, whether you want to talk about lame duck and just all these other reasons. But that's not coming. But when it comes to the economy, like the backbone of the economy, if rates are kept here, and let's say the Fed gets in another 25 basis point hike, maybe another one after that, maybe, and then they just hold it there. It is a controlled demolition, but the whole point of the word demolition is lower, right? Like it is going to be going down. It's not going to be. I've never said this, Tina. I don't believe one day we're going to wake up and the S&P 500 is down 15%, because that's what volatility is, what makes them step in, right? And they
No, they're not going to
basically
respond.
want
They're
to.
not going to respond to the stock market going down. That's not what they care about. They've never actually cared about that. They care about the financial system. But again, you're dancing around the point.
It's a
You're dancing around the point.
what
You're derailing the nature of the conversation. Again, you're not focusing. You're
Tina.
not focusing on what Joe said. You're really not. You're taking it off on a tangent and you're jabbering on about really kind of nonsense. The point is,
Tina,
you've
go
taken
sell
you've
your
taken you've taken it off.
Go sell your
You've taken
Bitcoin. Tina, you are
Magoo,
literally the epitome
Magoo,
of a fucking noodle hand Bitcoin
Magoo,
seller that buys
Magoo.
GBTC
If
and
I'm
then sells
Magoo, if
it.
I'm right and liquidity keeps getting sucked out over the next over
Well,
the
guess what, Tina? You're not right. You're not right, Tina. Like, there's a reason why no one ever brings you on stage is because you're a rambling boomer. Next.
Okay, guys. Will, take it from here, man.
Yeah. So everybody should get along, first off, and everybody should be heard, I think. But I get both sides of the conversation, right? I think we shouldn't necessarily try to prove our points versus try to discuss the issue and try and discuss the resolution, right, at the end of the day. And whether or not I would say we agree or disagree with who's listening to what or who's doing what, um, we should always respect everybody's opinion, right? So even if I felt Magoo wasn't hearing Joe, which I think everybody understood everybody's position that's on the panel, um, I that wouldn't be my point, right? I would basically just kind of move into what my point is and move forward with that. I think everybody on the panel had a solid position as far as their outlook and what they think is going on and what they think is occurring. And I think a lot of people are looking at it from the perspective that way we may not see a hard landing, right? But it doesn't mean that this thing doesn't come down the way that everybody thinks it will. Because yeah, a soft landing still you come down, right? The plane comes out of the air, it comes down to the ground, it just doesn't crash. And that's still down. So that's still cheaper prices. That's still, where I think a lot of people their heads are as far as where price action's ultimately heading. Um, yeah, yeah, that would be kind of my perspective on a lot of the conversation so far. Interesting though, very very interesting. Yeah,
That wasn't on my bingo card.
Well, that's why no one can have Tina on stage because he just can't have a civilized conversation. He always degrades into personal attacks and attacking people, and it gets annoying quick.
Well, it is a Friday night, so I'm gonna let y'all enjoy that. I enjoyed the conversation. I enjoyed everyone pushing back. I mean, I got to push back at everybody else too, because like I said, I like looking at numbers, and I'm wondering when number go up. And I think it's a little later. It sounds like Joe thinks it could be a little later too. Timing is always hard, guys, and that's the difficult part. So but I respect all the opinions and views, and I thank y'all for the great conversation I had tonight.
100%. Yeah, I appreciate you being on here too, Premise. I think you have some great outlooks. I mean, even me and Premise, we talked about different angles from what we were looking at, and the gig economy, and I'm gonna use that from forever now, the gig economy and all that good stuff. Um, but it's you. At the end of the day, you don't always have to agree. You just don't. You don't have to agree, but you should never live in an echo chamber either, right? You should always listen to other people's perspectives, understand their perspectives, and do you have to agree with them? Do you have to align with them? No, but you should understand them. So that way, if their side ends up playing out, you can look at the way you evaluated things versus the way they evaluated things, and be like, hey, this is where I messed up.
Yeah, but
I got too focused on these angles.
To do that, you have to show other human beings a modicum of respect and not completely degrade them just because they don't say something exactly how you say it or don't believe exactly what you do.
Yep.
And the problem I thought we were running into with that conversation is you have one particular individual just completely not showing other people respect. So it is what it is.
Yeah, I mean, those things happen. I think sometimes people get lost in the conversation at times too, right? I try to be respectful to everybody. At the end of the day, I'm not willing to sit on stage and argue with anybody. It's not my position. My position is to come up here and provide information for people so they can navigate the market in a better way, and so they can understand, what's currently going on with the economy. I think there's just so many people that are lost in the moves that are going on, and they're so focused on these lower time frames. What's going to happen next week? What's going to happen this week? Versus, where everything is ultimately looking like it's heading towards.
Yeah, sorry about that interruption, guys. But yeah, let's be respectful of all our guests here and all that stuff, and
So
try to limit some roughhousing. Although, getting into the heat of things is all nice, and we all got emotion and all that stuff. But it shouldn't ever go to insults and things like that.
Yeah, and you got to also remember too, just as a general thing, like I think it's important to be transparent. Like if you're going out here in a public stage and you're advocating for a particular conclusion or saying things are going to do this or they're going to do that, like it's important to be transparent about your positioning, right? Because as they say on Wall Street, are you really just talking your book, Are you really just trying to convince others of your particular positioning and why it's right? And you know, with some people, I think they come into these rooms, and if they're overly bearish or overly bullish, I think they're just trying to talk their book, which is not helpful, especially if they don't disclose that.
Yeah, that's sign language for Tina. Every time he talks, he just talks about his book. And if we want to be disclosures, let me just tell you where I'm currently at, so you can take it for what it's worth. Everything that I'm talking about, my probably I think last time I calculated, I'm around 83. Probably a little bit less now. 83% of my entire net worth is in spot BTC. Um, and the rest of that worth is a little bit of real estate, nothing investment based, mostly like where I live. Some public equity, probably like maybe 5 to 7% public equity. Another probably 5 to 7% in private equity, and a little bit of cash. So that's where I'm at. I have a little bit of cash, maybe actually, well, Bitcoin's probably a little bit lower now, so probably about 10% cash, about 10% between private equity and public equity, and then the rest 80% or around 80% is in just spot BTC. And I've held that 80% of spot BTC, even talking down Bitcoin, because that's just what I personally thought was going to
Right,
happen.
which is what
Um,
what I was getting at, Magoo. Like if you come, I respect your opinion here, even if I differ with you on some things, because you have a tremendous amount of exposure here, and even with that exposure, you're not saying, you know, like some people, like Bitcoin is going to rip to 500K this year or $1 million. Like you're not making those sort of wild ass predictions, because you have exposure, right? If Bitcoin goes down a lot, you're going to personally not gain from it. Contrast that with other people who, you know, sell entire huge positions and then suddenly start preaching about how the end is near and everything's going to collapse.
Yeah, no, and that is well on the long side or the short side, right? And I don't think anything's. I don't think nigh is near. Like I don't think we're coming into like a biblical ending here. That's for sure. Like I think we're going to be entering a modest recession. This is not like some GFC type level shit that's going to be happening. I believe we're going to see moderate unemployment from probably 5% if I cut it down the middle, upwards of 6%. You're going to see a 10%, 10 to 20% earnings recession. Probably just cut that down the middle and say 15. And the recession is probably going to last, depending on when it starts. Like we have a differing opinion about when it starts. I think it's going to start sooner. You think it's going to start later. But I think we're around the same severity level. Is that correct, Joe?
Yeah, I mean, I think that right now, barring some major systemic issue that hasn't been identified, um, I think you're in for garden variety recession, which is 5% unemployment. Probably, you know, given where asset prices are, I would expect, you know, double digit declines. But again, I'm not as confident that we necessarily even make new bottoms over what we hit last year.
Yeah, that is something to be said. Like if you just want to, well, Bitcoin and the SPY are a little bit different, but you are right. Like you might just see a double bottom in the SPY. I don't even know where the SPY ended up, like 34 or something. I don't know, 34 and change, or just 35 or something. There is a chance where it just double bottoms. There's also a chance, like what I'm targeting on the SPY for the bottom would just be pre-COVID highs, which I think are just 3,400, which isn't that far off from where the bottom actually
Well, we did have a double
was.
bottom, right? We had the bottom in the SPY in June, and then we had the bottom in October, which I consider that a double bottom because you're within a percentage point or two of the same bottom. So I
Was how close was that?
very
I
close.
didn't
So
realize it was
in let's get the exact numbers. So in
3.84
that's
difference
nothing. Yeah, I mean
percent.
you're functionally it's a double bottom. I mean, and I don't even think it was like a day, right? It was on an intraday basis before it reversed.
Yeah, it's wicked basically on a day. Yeah, both of them were wicks of a
Yeah,
day, of a daily candle.
yeah. 30, 36, 34. in June, and then the wick down on October 13th was 3503. No, sorry, 34.93. So you're talking, very, and again, on a closing basis, just like a weekly basis, um, the difference between the June close and the October close was, let's see, yeah, 2.5%, 2.3%. Excuse me. That's nothing. It's basically a double bottom.
I don't. Yeah. I don't even personally. When I look at general market health, I really try not to look at the SPY just because of how distorted it is with like Apple and Tesla, like because it really does not paint a broader picture of like how general equities are doing, even in the SP 500, because of how distorted it is with the big boys.
Well,
Um,
Magoo, they actually ended up removing Tesla from the SPY. I think like a year or two ago.
was it? So who are the big boys now in the
It's
SPY?
mainly energy. If you actually look at it, a lot of it's energy. A lot of it are bigger players like Google and stuff like
But it
that.
doesn't matter because the
Um,
story is the same. Go look at RSP, Magoo. If you pull up a chart of RSP, which is the equal weight S&P 500, meaning that all the top 500 companies get an equal weight. You're not over market capitalizing the mega caps. It's almost the exact same story. You see a bottom in June again, and another 2 or 3% down in October. It looks almost identical on an equal weighted basis.
oh, I see we got Jaguar up here.
Hi guys, what's going on, Jaguar? Good to have you up here, brother. Had to mitigate some previous conversation, but when I noticed you in the crowd, decided to send you an invite to speak, man. So let's just say conversations like that won't be happening again. It's good to have you up, man. Thank you for taking the time. Welcome to the crowd at Because Bitcoin and all that stuff. With Magoo being our special co-host of the day. I appreciate that, and thanks for having me. I actually missed. It looks like I came in right in the middle of the storm. Um, so it was a very interesting exchange, and I was like, okay, I thought this was about markets, but something else is in play, perhaps. And but it was interesting. I caught the tailwind of it. I think the debate there, as I gathered, was really about to boil things down, as I understood, was whether it's something some events that would lead to an imminent crash or something that will be much more prolonged and painful in nature that bleeds this market much slower to the downside. But I think directionally, the message, whichever side you may be on, was still the same, whether we can all see the trends that are right in front of us as they're unfolding. It's the pace that can be debated in these spaces, and that it's one person's opinions versus other, and so it's the pace that matters, right? I think that's where the disconnect was coming from, and I have to say that the this market is not easy for anyone, even for the pros. um, and if you just look at, for example, just in the past 2 weeks, we had 6 consecutive days or 7 consecutive days of 0.6% range in the S&P. 3 of those days, market closed within 0.1% of the prior day. Um, you have VIX termination going on in a massive scale, the volatility suppression that I'm seeing across the board. You have seen volumes drying up meaningfully across everywhere. It's the market is simply not giving anybody an edge to make money long or short meaningfully, except unless it's a market of stocks. It's not a stock market, it's a market of stocks, so you have to go shopping and find. And so I can only speak for myself as to what I have been doing and what I have been trading. Is I follow, you know basically a quad model.
which was originally invented by Goldman Sachs in the 1960s and then later developed and adopted by so many shops and changed in different ways. But it's a very simple but a pretty powerful model. Basically, you identify the market into four quadrants, and these quadrants tell us, whether either you have four combinations, right? You have inflation rising and real time and real GDP rising. You have inflation falling, real GDP falling. You have inflation rising, real GDP falling. You have inflation falling, real GDP rising. So four quadrants, right? And depending on which quadrant or which quad you're in, you have a basket of stocks that tend to work, sector wise in that particular environment to their best, that basically beat the S&P materially. I'm pretty sure many of you are already familiar with this, so I don't want to rehash this too much. But based on the trends that are in front of us, which is the combination of falling inflation and falling real GDP output, as very, very clear in front of us from all the macro data, we are firmly placed in quad four, right? And what works in quad four are only three sectors. What are those three sectors? Those are the three most ultra defensive sectors. So that's your staples, healthcare, and utilities. That's it. And long bonds, that's a side one. Because ultimately, you would expect the economy, whether it happens on a slower pace or on a much faster pace, which is up for debate, as you were having before. But aside from the pace, you are firmly positioned in quad four. So if you pull up the charts, while the market was dead, particularly in the last 2 weeks, and, not giving any chance to anybody who's trading the index to make any kind of money, long or short. But take a look at absolutely gorgeous rallies on a consistent basis that are unfolding in front of us in staples, the boring stocks. I mean, everybody loves talking Nvidia, Tesla, and all that stuff nonstop every single day because that catches the eye. That's the sexy part of it, right? The where the sexiness of the market is. Everybody looks at Tesla every single day on their watch list. I mean, Elon Musk owns Twitter, and right here we're on Twitter talking about all kinds of stocks. And that's what steals the thunder. But nobody brings up that Coca Cola and Pepsi and General Mills and Kimberly Clark and all of these staples basket, just every day they just trend higher and higher and higher. Pull up any of those charts, McDonald's for that matter too. Same with that club. Starbucks is breaking out gradually as well. That's working. Utilities are waking up. My favorite name continues to be PG&E, PCG, quietly breaking out to new 52-week high. I think it's going to 20 plus. That continues to work hard. And I think right behind it, Nextera Energy, symbol NEE, which is the clean tech utility, one of the best run companies. And I think that's going to wake up pretty soon, too. I think it's too depressed over here. And then you move on and you take a look at the third group, which is healthcare. So here, which is, and I've been writing this for the last couple of weeks, and I was tweeting about this earlier as well. Look at the breakouts in Stryker, SYK, the surgical equipment maker.
Oh yeah, I've been following that one too. That's a good one.
Look at the breakout in Zimmer Biomet, ZBH, which makes the total knee procedure. I mean, how come these things never, bring up for discussions? Look at the breakouts and how many people talk about that gorgeous quarter with sharp increase in guidance from Intuitive Surgical, ISRG, that we saw a couple days ago. Medtronic had a fantastic news tonight, just before the market closed, that one of their products that is already selling very well internationally finally got an approval from the FDA. And I think this stock is depressed. This is starting to wake up with the rest of the group. Boston Scientific is waking up. We have Inspired Medical, INSP. A lot of these diabetes and med tech stocks. The thing about these med tech stocks, and I'm not talking pharmaceutical or biotechs, I'm talking large cap, 50, $100 billion club names, large cap med tech stocks. What most people don't realize is that, I mean, it's as obvious as it may be, When the pandemic happened, we know the elective surgeries were put off for a long, long period of time, right? And then just as we started to come out of the pandemic, then this entire group was hurt by nursing shortages and massive supply chain shocks, as well as inflation pressures. So their margins got killed. So basically, we had a period of 2 to 3 years of just lackluster earnings growth. But now, starting from really Q4 of last year, and then more so as we're seeing in the channel checks in Q1, we are seeing improving trends appear from both margins and sales perspective, with accelerating growth for all these med tech. So these things are breaking out, right? And they're working. That's your quad four playbook. So it's a market of stocks, and we are in quad four, and the best areas on the long side to attack are staples, utilities, and healthcare. And one can park money in these areas and be long along on the side, be long bonds as well, like I am, and be comfortable with the market. If you want to be long something and actually produce some outperformance. But at the same time, I'm also very actively short the market too in many different areas, from Coinbase to Moderna to staffing companies such as Robert Half International, and Capital One Financial, and those to the companies that are tied to the auto credit cycles, such as Credit Acceptance and World Acceptance, which sells loans, which gives loans to subprime lenders. WRLD is that stock, as well as many other, and then even banks. I have a short position in Blackstone. I'm short PNC, and some of these regional banks where I see continued trouble ahead of them. One has to use the bifurcated approach. Can't be just judgmental about everything at once in the same direction. I mean, you have pockets working higher, you have pockets working lower. Cyclical groups are getting gradually murdered. Did anybody see what happened in metals and miners today? Pull up the chart of Alcoa, US Steel, Freeport McMoran. They got destroyed today. BHP Group, Rio Tinto got absolutely annihilated today because overnight, on Thursday night, Friday morning, we got the European PMI manufacturing data, which collapsed across the board. Germany, France, UK, the whole Eurozone PMI was a disaster. And US is not doing much better either. US, we saw the Philly Fed came out. That was a god awful number. So, you can use a long and short book if you know where we are in this quad model. And we are firmly in quad four. And that's how you can come out ahead of the market without having taking an extremely one-sided view that, oh, we're gonna just completely crash and burn, or we're just only gonna go up and up and up.
So you're telling me the hedge fund model might not be dead. That this decade the hedge fund model actually might make some money.
Absolutely. This is a very active, this is passive investing is died sort of last year, if you ask me, right? I mean,
I think passive investing will probably be somewhat muted for this entire
yeah,
decade.
that's what
I
happened
think
in
you're going to have
'70s,
to
right?
be, yep, you have to be very selective on what you're investing in, and not this generalized and put my money in an ETF and just expect to get my 5 to 6% return year over year. I think you have to be very smart and selective. And I think this is the decade because last decade hedge funds sure didn't beat fucking even the SPY returns. Maybe this is the decade that hedge funds make a comeback.
Yeah, I 100% agree. I had quite a bit of discussions. I have a lot of clients that have their own clients, right? So they run family offices and hedge funds and institutional clients. And I talk to them and they ask me and I ask them. It's a back and forth nonstop conversation. And oftentimes this is precisely what we come to, where we start discussing, okay, how much does one need to take a passive approach here? Or do we need to change the style that we had in the ZERP environment of the last decade, where the passive investors basically killed everybody, right? I mean, it works so beautifully because of the easy money that was in place, but now you got to get a little bit more proactive with your approach, and can be dogmatic about just all being long at once or all being short at once. And it's a very bifurcated market. And I think strong, good money managers with sensible approach and running a simultaneous long and short book and finding opportunities, I think are going to do very well. And we're going to find out as this decade unfolds who those winners are. They're not in the spotlights today, but they will be the ones that will be the next ones to replace car icons of the world, and they're going to emerge those names in front of us.
Guys, I just want to take the moment to say that we are running a little short on time. We have about 25 minutes left of Spaces time. So, what we're going to do, we're going to go to Will, then we're going to go to Sisu. Actually, no, we'll go to Sisu. I know he's been here for a while. We'll go over to Sisu, then we'll go over to Will, and then we'll finish off with Nick. But I want to remind you guys, in case you're new here, my name's Wabi. I host Spaces throughout the week for Because Bitcoin, and this is really one of the first few times that I'm hosting more of these, I guess, macro spaces, really. I mean, I'm learning just as much as people in the audience here from individuals more experienced than myself. But Jaguar, I'm not sure if you've been to our other shows before, but I'm sure Will's Outlook and yourself can connect. We'd love to have you in one of our other scheduled programmings. Will's more of a diverse guy. You can see him across all of our shows. So if you'd like, to participate in our future spaces, feel free to join at any time, man. You're a very well versed individual, and
It's funny because I every day I see this, uh, because bitcoin.com handle the yellow one pop up in the spaces. Okay, it's running, and I always join. I don't think many people even realize, almost every day whenever I see it, I join and I just listen quietly. I think this is the first time I was, when you asked me, to join in as a speaker, so I did. But I think for at least a month and a half now, I've been a regular every single time when I see it, which is almost every day.
yeah, man. Good to have you up, man, and welcome to the Because Bitcoin community. I myself, I drive all the digital asset stuff, so things like Ethereum, Bitcoin, DeFi, sometimes all things of the like, or community thought leaders like Magoo who've been in the industry for a while, and sometimes some cool folks, friends of the brand like Joe Carlos here. We call him Uncle Joe around here, so that's always nice to see Joe participate in most of our spaces. Really, he's almost like a regular. I feel that there should be some Uncle Joe T-shirts. Really, man. So look forward to that. Look forward to that. But Sisu, go on ahead, brother. We'll go over to Sisu, then Will's outlook, and then we'll wrap up. We'll wrap up with Nick. But yeah, guys. Please follow us here Because Bitcoin. Every single follow means the world to us, man. We love being introduced to new people in the investing community as a whole. And yeah, guys, thank you so much for participating in this more late night spaces. So, Sisu, go ahead, brother.
Thanks, Bobby. I just wanted a quick question for Magoo and Joe. This week I thought was super interesting with Gensler's time in front of Congress. And I wanted to get you guys' take on how you see what the U.S. exchanges will look like for the next bull run. Do you think Gensler's going to win? Do you think the game of chicken that Brian's playing right now with the Bermuda license is going to win out, and his pressure on the people that he's supporting is going to win? I think there is a chance. I feel like that a lot of the shitcoin activity will get dampened, and maybe we'll have Asia lead the next pump into the next bull run. So how are you guys looking at what's going to happen with the exchanges over the next 2 years?
Let me see if I can get Joe back up here. He moved back down to listener, but let me give you my thoughts. So let me specifically talk about Coinbase first. I said this in a tweet yesterday. As much as I dislike Coinbase, just for them basically having a degenerate casino. Um, I just like Gary Gensler even more, just because he's not sensible, right? He's trying, and the way that I view this is he's trying to amalgamate power under the SEC, and they're trying to basically, so not only is he trying to bring under the SEC's um, house, I'll call it, of digital assets, he's having a hard time fitting digital assets into the existing rules, and so he's trying to change how existing rules work and what they encompass, and that is pulling in some of even the traditional finance things. One thing that he's getting massive pushback from, where I think the SEC is going to get bludgeoned to death with, is qualified custodians. He's trying to change the definition of qualified custodian and to basically institute new rules for QCs that have massive implications in traditional wealth management space. That a lot of these RRAs are not playing ball, and they're pushing back um, quite extensively against him. And that is just one of the things of, like, I'll call it the unforeseen pushback on Gary, because he's trying to basically try to have a one glove fits all approach, and just being honest, like, as much as I don't like shitcoins and I hate them, Gary is being rather disingenuous with how he's trying to pull everything under a one glove fits all rule, because it just doesn't work. There's so many moving parts, from broker dealers to QCs to exchanges. What qualifies as an exchange? Like, he talked the other day about, now he wants to redefine an exchange to something that's theoretically a protocol. He wants to say an internet protocol that basically aggregates matchbooks is an exchange, no matter how that looks. Even if it's an internet protocol, he's deeming that an exchange. And so there's a lot of things that he's pulling in that I fundamentally disagree with. And I think, and I tweeted this out yesterday. It's like, I don't think Brian is in Coinbase is going to try to beat Gary Gensler in court as things stand today. I think they're playing distraction, and they're playing stall tactics, to where they actually want to beat Gary Gensler in Congress, in the Senate, not a courtroom. And that's what I think their playbook is. And as opposed to what they're doing now with the Bermuda license, they're not the only ones. Gemini also announced today that they are creating an offshore non-US derivatives exchange. And so this does two things, in my opinion. This lets them operate at first of all, derivatives fall under the CFTC. They don't fall under the SEC, even if so the SEC has no jurisdiction there, even if it was inside the United States, but they're moving offshore. And there's a potential, a lot of money there, because a lot of the money, like, and people don't realize this, a lot of the money that was actually going into the last bull run, whether it was spot trading, whether it was derivatives, it was a lot of it was coming from offshore. So there is a massive market for offshore money. And this last bull market, all the offshore people came to the United States. Whether it was through broker dealers, whether it was through Genesis, whether it's whoever, a lot of them came to the United States to do business. Some of them didn't. There's still Binance, obviously, for the spot markets, and there's FTX, which was offshore. But there is a ton of money offshore. And so, one, this gives them a business model offshore where they don't have to worry about the regulation that's happening inside the United States. And then two, politically, what it does is it draws a line and creates a wedge, a political wedge, where you can be like, look, Gary Gensler forced us to do this. Look at all this business that we're doing nicely. Look, we're following all the CFTC rules internationally, and we're following all these regulatory bodies in other nation states, and we're making a fuck ton of money. And that's showing like a product market fit, and that's tax money and GDP that you're driving away from the United States, and you're driving it offshore because of how dumb Gary Gensler's being. And so it kind of does two things. So ultimately, Coinbase is going to try to fight Gary in the Senate and the Congress, I think, before they try to fight him in court. And that's what it seems to be their approach is. And, like, literally, ironically enough, like, and I swear to God, I do not not work for Coinbase or anyone remotely even close to Coinbase. Yesterday, I said this exact words. I said, Coinbase doesn't intend on trying to beat Gary in court, but stall long enough to beat him in Congress and the Senate. And literally 8 hours ago, Brian basically tweeted, hey, we met with the SEC today. Um, also important for regulators to set policy, then enforce it, not start with enforcement. And there needs to be clear rules. At this point, it seems like Congress needs to step in. Like he literally gave a wink and a nod to like, this is what's going to happen. Like they need Congress and the Senate to step in. And this is something that's going to take a long time to play out, I think, in the courts, not only in Congress and the Senate, but then the actual courts as well. So, are things going to look materially different in 5 years? Fuck yeah, they will. There's going to be a lot more regulations. But is everything going to be regulated by the SEC? That I'm not so sure of, right? You have all these fucking anon accounts on Twitter that are short sellers that are basically going around basically saying, oh, Gary Gensler and the SEC are going to fucking bring down everything and yada, yada, yada. Because mainly they're short selling. They're short sellers, right? Um, and I honestly think that the SEC's not going to win this, at least with what they think that they want to accomplish. I just think it's going to look materially different. Like I think there's going to have to be new laws on the books. I don't think you can fit this into the current laws that are on the books with the SEC and securities. But that's just my 2 cents.
Got it. Appreciate it. Yeah, I just see this as the last important piece of FUD that people have, at least the institutions that have the real wealth that they can pile into Bitcoin. And the second this gets resolved, we can quantum leap 10x. But what your take on how long this might last is kind of worrying as well. Like if this does go
It'll
out,
take a while. It's going to take
yeah,
a while.
it's a huge problem.
I
But
wouldn't be and this is where my original prediction comes from when I said when are we going to see a spot ETF in the United States, and I think I've been saying it's either going to be it's probably going to be 2025 at earliest or late 2024, is because all of this shit needs to be settled before that actually is allowed to go ahead. And it needs to be, and so it's just going to take a while for this to get like flushed out. Like Congress and the Senate move extremely slow. A potential case with the SEC is going to go incredibly slow. All of this is going to be incredibly slow. Like it's not something that's going to be resolved this year. That's for sure. If not, maybe not even next year.
All right, we'll go on over to. Go ahead, Steve. Go ahead.
no, I was just saying, appreciate it.
Well, go on ahead, man.
Hey, how's it going? First off, I want to thank Jaguar for coming up. I followed you on a couple different spaces. I think you articulate what you had to say very well. I think that your positions on the market are very sound. I'm in a complete agreement. I've been following energy for a while. I know a lot of people think it's dead, but I think energy is one of the best safeties you can go into a recession, as well as bonds and so on and so forth. I've taught bonds on multiple spaces already, and I know people find that boring. But I find it interesting, the staples conversation. And when you brought that up, I thought about something ridiculous. And that ridiculous thing is Alta. So if you want to see an up only chart, look at Alta Beauty. It's ridiculous. Um, Outside of Striker and so on and so forth. One other one too I wanted to kind of bring up, because you brought up Starbucks as a staple, and I kind of agree, but I kind of disagree. I think it's more of a service. And I look at also with Starbucks in this scenario, and I'll try and keep this short. It's kind of overexposed on China too, and I see China as taking some pretty hefty downfall. They built, I think, 140,000 stores in China during COVID, and I think they're continuing to expand. And their anticipation is to build 900,000 stores in China or something like that. I think is their anticipation. I think China's going to get hit pretty hard during this recession when it comes down to it. And even if the U.S. doesn't take a soft hit, which I think we'll end up rolling into a lot of these staples that are overexposed to China. So it's something I've been kind of paying attention to. And one other up only chart that I've been on top of pretty well is FSLR. So just kind of bringing that to your attention, and it's literally just came over in 2022 and just blew up in a straight line. It's pretty crazy. It's a solar company.
If
What
I could just, can I just quickly address all those three? And I think
Yeah.
it would be very informative. So on the Ulta, you have a very interesting. Uh, we were a little bit perplexed about this too because it's not just Ulta. If you look at Elf Beauty, ELF is the symbol. I mean, that's another beauty stock. It's a monster stock. It just does not care. It just keeps going and going and going. Then you also pull up the earnings report over in Europe from LVMH and a couple others. I mean, it just seems that the entire beauty space acts like defensive in nature. How long can that continue? Only time will tell. The second one was, I'm sorry, the second one was a healthcare name, right? Which one
So
was
I
that?
brought up Ultra Beauty, and then Starbucks was my
Yeah,
second
oh,
comment.
sorry, the Starbucks. Yeah. So
Yeah.
a quick thing about the Starbucks. 100% agree with you about your economic take on Starbucks. One thing I will point out is that the I think this is a celebratory time because we have Howard Schultz back in the game, right? So he's running the ship now. The old management is out, and the company went through a period of very long lackluster period, and it's sort of the same way that I believe, despite market hating Disney right now, but I think Disney would also wake up. And we may see a couple quarters of improving trend despite the economic turmoil that is still in place, because we have there too Bob Iger back, right, on the leadership position. So I think he's changing things. The same thing is happening with Starbucks. So if you look at Starbucks growth projections, they're 1%. And it could, of course, in a full-blown recessionary environment, this could get worse. But I think some credit has to be given to the management, and how it may actually perform better slightly than some of the other peers. And so it is sort of, I sort of put Starbucks between as a staple and discretionary, and so we'll see exactly whether it can continue the momentum as well. And China reopening only started in January. I think in 6 months now it could fall apart, but for now it's still in play. One thing about on China that I will say, similar to the United States, when we came out from pandemic, the U.S. savings rate was 14%, because how much we had accumulated basically from all the stimulus checks, which we have been depleting at a very, very rapid pace, particularly during the stagflationary period. And by the end of the year, almost 80%, 85% of that will be gone completely. In fact, we're probably, the US consumer is going to hit a brick wall, in my opinion, once the Supreme Court issues this decision about the student loans that's coming up in June. That's $393 per month in payment, and that's going to be a direct hit. But similarly, in China, when they came out from 2 year lockdown, their savings rate was 23%, a decade high, and now they are spending violently everywhere. They're going around. That's visible in Las Vegas Sands earnings report that came out this week. You're going to see the same thing in Wynn Resorts, for example. If you look at the traffic trends, the airport traffic trends in Hong Kong and many of the places, they're just going bonkers. I think at some point it's going to run out of fuel, sometime maybe in the next 3 to 6 months. Maybe that's when the negative trends will start to emerge for Starbucks as well. But for now, it's in play, along with better manager running the company. And the
Jaguar,
Yeah.
what do
last,
you what are your thoughts on the geopolitical risk that with anything exposed to China?
it's huge. It's huge. I mean, that's why I don't touch any of these Chinese stocks. I mean, I'll play Las Vegas Sands because it's a American company that is benefiting from the trends. But if anything, I look for rallies in Alibaba and Pinduoduo and many others to short, or just KWAB for that matter, because I cannot, the unknown part about Chinese stocks, the risk for Chinese stocks start at 4 o'clock 4 p.m. Eastern time when the market closes. Because I have no fucking idea what will happen overnight. I have literally no idea what will
Yeah,
happen
that's
overnight.
my major concern with Chinese stocks, and even you see Berkshire and you see fucking good old cross-eyed Munger basically, and Warren talking about selling basically selling silicon manufacturers in Taiwan because of the risk that exists there. Um,
And I
he
think
really
that's
have.
why Warren Buffett, who likes to hold on to his position for years and decades, I mean, he bought Taiwan Semi, and 6 months later, he dumped the entire position. One of the fastest turnarounds in his portfolio. Question is why? And I
Well,
think
he
the
went on
answer,
national TV and basically, like, he almost let the noodle slip when he talked about geopolitical risk, and then he transitioned it to saying like there's basically earthquake issues, like because he almost let it slip with how much danger there is with China invading or doing something, right? Like, so that risk is quite large. Like, if I
you
was
know, and the funny part about this discussion is that Taiwan Semi would be the most obvious one, but the thing that keeps me awake at night, and we talk about Black Swan, right? Because if there was ever to be a scenario in which there is a direct conflict, a war breaking out between China and Taiwan, guys, you have any idea how much US investments is in China and how much we import? Do people know, for example, a minor small example that many people don't even know? 92% of all aspirin sold in the United States, as simple as aspirin, is imported from China.
so that's
92%.
You're hitting on a good thread there, and that's ultimately why I believe the United States will not interfere if China moves on Taiwan, because they can't. The only thing that is like national security level strategic things that they need is this silicone manufacturing. And they're already reshoring that by investing billions and billions of dollars in making those plants inside of the United States. My like, if I was putting on my tinfoil hat, I would say that it is a known quantity, that it's known to Ping, and it's known to whoever is in office in the United States, is that as soon as they de-risk the silicon manufacturing out of Taiwan to the United States, China is going to move on Taiwan and the US is going to do nothing.
That's precisely why I spoke specifically on what I think Starbucks is doing is overexposing themselves to China, as well as I think many companies have. And I can tell you 100% China will seize their properties and take everything they have. They will lose
Like
that.
the
There
old
are
Soviet Union did, right?
there are 5 foundries opening in the next 3 years,
Yeah.
stateside.
Tesla gets 30% of its revenues from China. I mean, Boeing, all the Boeing wings for its planes are made in Taiwan. I mean, so what does that do? And then we can just go down the list. Pentair, the pool equipment maker, gets 80% of its parts from China. They can make parts, without those factories running there. It's not one thing. It's the 20 undoing or reversing 25 years of globalization in a switch. If there was a war and significant deterioration in relationship between China and the US, is a black swan
Oh,
and how
100%.
bad, I have no idea.
Generations of Confucianism is not going to be emotionally reactive. I'm
Yeah.
more
Yeah, at
concerned
the
about
end of
what's going to happen in like South Asia, not in terms of like the pack all the stands and Sri Lanka and stuff like that over China and Taiwan.
Yeah, the one thing is, like, I think this decade is going to be a deglobalization decade. Like, everything that was built since the onboarding of China to the world economy in 1990, I think that is starting to reverse. And the ultimate goal is to do that over the long haul, the next 10, 15 years, and not hope for a black swan to where it's a light switch moment. But ultimately, because, like, if you read a book by like Ricketts and basically Sold Out, like, they're already trying to restructure global supply chains. It's just that it has so much momentum that, like, it's going to take at least a decade, if not decades, to take out the manufacturing base of the world, China, out of the supply chain. Like, that's just not going to happen anytime soon. And so the risk is that if China does move on Taiwan, I don't think the U.S. really has a choice, in my opinion. And it's why Joe Biden even beats around the bush when he talks about supporting Xi with one China policy, right? They play their devil's advocate when they send their politicians to Taiwan against the recommendations of China, but they are very cautious when talking about, like, one China policy, right? And to me, I don't think if China moves on Taiwan this decade, I really don't think the United States can really help. Like they can help with how the United States is helping Ukraine against Russia, but they can't. They're not going to inject themselves into a conflict with China. They might supply Taiwan with weapons. Like they might supply them with whatever they need to defend themselves, but you're not going to see U.S. naval carriers defending Taiwan. Like I at least this decade, I don't see that happening because if that happens, that's global thermonuclear war at that point, right? There's
There
no.
may not be a direct, and I think there's some good logic to that and reasons behind it. There may never be a direct conflict where the U.S. gets involved, but the repercussions of this, in the sense that, okay, so in the wake of when the war started in Ukraine, how we use economic sanctions and tools available with our allies in Europe, in European Union, to push Russia back in the ways we cut him off from SWIFT system. We
Can they do that to China though? China's a
That's the
different
thing,
beast.
right? So I don't know. That's I think that we have to at least be, there may not be a direct military conflict, just like arguably, technically, there is no direct conflict between NATO and Russia today either, although we're supplying weapons there too. We could have some similar situation where it's all economics at that point. So if people were, if people's what we saw during pandemic with the supply chain issues will end up being will end up looking like a walk in the park. Like that was nothing. What comes next, if there is a true full-blown conflict between
Well,
Russia and China in terms of supply chain shock?
to add
Hey
to what
guys,
you're
hey
saying,
guys,
Greg.
hey guys, hey guys.
Yeah.
I know there's a bit of a flow of the conversation here, but I understand that Nick has been waiting for a while to ask his question. Nick, I'm sorry for that, brother. So and I want to let you speak. If you have a question for Magoo or anyone else on the panel, feel free to do so.
Hey, thanks, man. No, I don't really have a question. Honestly, I was loving the conversation. It's really interesting to think about just as a tail risk that's out there. But I think it also kind of speaks to, you know, I think the conversation that Jaguar and Will were having earlier, which is that in these type of environments, having a somewhat, equally weighted long short strategy, if you're, playing that game, is likely going to be the winning one. And Magoo, you kind of you kind of said earlier, like, oh well, is the hedge fund strategy going to finally work after them being outperformed by long only portfolios for the past 10 decades? But the reality is over a long enough time, it takes one or two extremely bad years for that long only strategy to get completely screwed. And the typical response from that type of portfolio manager long only is going to typically refer to something like alpha, which I think if you look at just the numbers, it's kind of bullshit, right? Because you could be, for example, getting a 15% compounded year over year for like 6 years, and great, you 2x your money. But one bad market fall after that, to the tune of 35-40%, you're basically at square one. So I think, yeah, I just, you said that a while ago, so I raised my hand quite a while ago. I know the conversation's kind of taken it elsewhere, but I usually just see so much of a disparity on FinTwit, which is typically like people are either extremely long and they think we're in a new bull market, or we're about to enter depression levels. And who knows, either one might be right. But to stay in the game, I don't think you can structure a portfolio like that, because it's just begging you to get blown out at some point. So no, please continue though with the geopolitical stuff. That was awesome. That's all I wanted to say.
Well, go ahead, man. Will's outlook.
I lost track of where I was at. No. Yeah, no,
It happens,
I think
man. It happens.
I think this is a great conversation. I think it's a great conversational piece. I just wanted to point out, though, and I always think about these things. This is why I always bring these things up, because people look at tail and risk. They look at what the possibilities are. But I also look at it. I look at it from two ways. There's tail and risk to this scenario playing out, where China goes into Taiwan. But I look at China as they're a GDP country, right? They produce. They're a production company. They don't have a lot of growth potential. They don't have a lot of things that they're kind of necessarily innovating on. They are producing and selling to the world. So to close them off from the world is to close off their economy as a whole. And I think they understand that, just like we understand to go to war with them is to kind of shut down our consumption, right? Because we're a consuming country. And that's what a lot of people don't really look at, is what countries consume, what countries actually produce. China's a producer, the US is a consumer. Yes, we produce, but we consume a lot more than we produce. Hence GDP, versus our debt, and so on and so forth. And I think that that's the way I typically look at it. So it's hard to tell if this whole scenario could actually play out, of them wanting to act on Taiwan and wanting to put themselves in a position that could financially stress their entire economy to a point to where they could be financially destroyed for decades.
Well, man,
I think they're in a tough spot regardless. Their population is in collapse at this moment. So that is going to be a very big headwind to their economy in general. And they need to orchestrate they need to orchestrate a collapse, like a controlled demolition. Because the way that China's economy worked over the last 30 years is not how the Chinese economy is going to work over the next 30 years, because it can't. Their population's in collapse. They need to actually start consuming things that they produce, and they need to change their economy from basically the manufacturing base of the world to they need now to be an advanced country and actually start consuming themselves. And that's the only way that they can survive. They have a huge debt problem, probably one of the worst in the world. So that means that their currency is going to be devalued at a pretty large stay. So it's going to be interesting. The next 30 years, it's a different ball game for China.
Well, guys, this has been an interesting conversation. I think we've reached a good epoch to wrap up here. I myself, dude, I'm gonna make myself a steak, and then, as an American, I'm gonna backstop any sort of crazy depression from happening. I'm gonna go to Costco, and I'm gonna get the hot dog combo, and then I'm gonna take a pizza combo, and it's the most stable asset in the history of mankind. It's been the same price since the inception of Costco. So when you really think about it, anytime you go to Costco, you upgrade your membership, you keep it consistent, you get your hot dog combo on a nice Saturday night. I like to get a Sprite, no ice, plain hot dog, maybe with some sweet chili sauce and some ketchup, and then just chill out on the bench and have my hot dog and my Sprite in peace. And that's really what it's all about. That's really what it's all about as an American. You are, by definition, doing your part to backstop any sort of massive liquidation risk to this country. But anyways, getting on a more serious note, Magoo, thank you so much, man, for participating in this space that's been going on for close to 3 hours now, man. It's always a pleasure to connect with you and seeing your animal spirit come alive, man. Looking forward to reconnecting over the summertime, hopefully. Or if you're going to be in BTC Miami, maybe we can play some basketball with Uncle Joe or play some chess with Big Ben. He's gonna be there into the cryptoverse. So yeah, thank you all so much. Thank you to Will's Outlook and Snorlax and Premise for being up here earlier. Thank you, Kimchi. Thank you, Forest Green. Thank you, Phi Capital. Thank you, Nick. Thank you, Susie, for coming on up. And also thank you, Jaguar on Analytics, brother. I want to welcome you to the brand. And yeah, man, we like to welcome up individuals that are enthusiastic about all financial markets. I myself, I play crypto exclusively, Bitcoin and crypto. If you want to be more specific, I do deem both asset classes differently. By definition, they are. But anyways, man, I like talking about markets in general. I
Real
like
quick,
price
Bobby.
action.
Oh, go
I,
ahead. Go
I
ahead.
gotta I got to cut in and cut you off. Don't
Go ahead.
forget to follow at Because Bitcoin
Oh,
if you guys want to
yeah,
continue keeping
yeah.
up
That's right. That's right.
with the latest
I
news.
have a script. I have the I think I went into another space and someone is like, Wabi, you have to say, don't forget. Yeah. It's like a little bingo card game, right? So I'm gonna do the catchphrase now. Guys, and if you enjoyed this conversation, my name is Wabi. I host these spaces throughout the week with individuals from digital asset space, whether they're devs, founders, community thought leaders, and of the like. Feel free to follow Because Bitcoin and turn on bell notifications so that you can be made aware of when every single space goes live. We host various spaces throughout the day, and we're also doing somewhat of a pivot onto our YouTube. We have some YouTube shorts. I myself, I, with the help of one of our producers, created a little YouTube short about a new wallet that got released onto the iOS store, which I found pretty cool. And yeah, we also do a Sunday space now, streamed from YouTube. It's just me and some of our other team members every Sunday. Our first stream was this previous Sunday at 8 p.m. Eastern time, if I'm not mistaken. And yeah, we'll be doing a YouTube video with David Hunter, who's a proponent of the melt up theory. So feel free to check out our YouTube for all of our previous recorded spaces. And yeah, typically, you know, these spaces are almost immediately uploaded onto our YouTube channel about 2 minutes or so after they're completed. And as far as this weekend goes, we'll be hosting a few spaces on Saturday and Sunday. So look forward to that. And yeah, feel free to follow us. Every single follow means the world to me. I get enthusiastic about it. For every one follower that we get, I do one push up. So let's just been saying I've been working on my push up game and not just my barbell game. But speaking of my barbell game, tomorrow I'm going to train upper body. So here's my workout schedule. I'm going to do my log presses, my dumbbell presses, my barbell rows, my lateral raises, my upright rows, my tricep extensions, my barbell skull crushers, my dumbbell curls, my preacher curls, my concentration curls. So yeah, I got to get ready for all that stuff. So thank you for your
I'm
support,
assuming you're
guys.
doing one of each one of those for every follower that we gain, right?
Yeah, dude. So for every follower that we get, dude, that's an extra set. So feel free to help me get jacked. We're gonna try to run it up. And yeah, let's get the pump on the coin, and let's get the pump on the follower account. Appreciate you guys so much for sticking around through all of the spaces that we had today. I think I hosted about 3 spaces today, and then we had a market talk, of course. So we did about 4 spaces, and the one we did with Ben Cowan was about 3 hours. So this space was about 3 hours. The Ben Cowan space was about 3 hours. The one that I did with Unsheath was about 1 hour. So that's 7 hours. And then Carter did market talk for about an hour and a half. So basically, about 8 hours or so, give or take, like 15 or 30 minutes. I think I rounded off quite a bit there. So a lot of content for you guys. It's for market participants, by market participants. And yeah, I guess I might announce also here that we will be relaunching our new website. So you'll be able to see a bunch of articles from community thought leaders and builders in the crypto space. So look forward to that, and also more entertaining spaces like these, whether you find them educational, whether you find them funny, whether you find them annoying. Every single eye that pays attention on these spaces is good. It does cater to our algorithm. So thank you for all of our fans, both good and bad. God bless you all. God bless you, your family, and your loved ones. For myself, I like to go by kill them
Just
with
close it
kindness.
off, Wobby. Jesus
I was gonna
Christ.
All
say
right, all right, all
you're the
right.
one dragging it out now. You said you wanted to get off.
Okay. All right, guys. Thank you so much. Thank you so much. Follow all of our follow all of our speakers on the panel. Thank you so much. We'll be back tomorrow. And yeah, God bless you all. Peace out, man. Peace.